As long as earnings are okay, the market can ignore a lot of the bad news.
The whole market looks pretty good, actually.
The market has been remarkably resilient.
Markets seem to be calling the all clear here.
We're going to see in the short run as the market can move higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, pressure building on Chairman Powell.
And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad. So we have a stupid person, frankly, at the Fed. I call him Too Late Powell because he's always too late. I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible.
President Trump doubling down on his criticism of Fed Chair Jay Powell. The Journal reporting Trump is toying with the idea of naming his replacement early, with as many as 5 names in the running. Hassett, Walsh, Besson, Malpass and Waller, as the dollar is starting to sniff out a shadow Fed chair.
Yeah, you're seeing the dollar this morning at its weakest level since 2021, particularly versus the euro. The euro at the strongest level since that time. And this comes as people expect whoever it will be, the shadow Fed, to push the overall committee to a more dovish stance. And you are seeing that baked into Fed funds futures as well. I wonder how this works. Just remember, if he does nominate someone by September, that person will be the shadow Fed until May of next year as we get that sort of a term expiration of Powell.
There's a lot of runway there, and Lisa's pointing out a really important distinction. If you're just waking up to this news, this is not about an early replacement of Chairman Powell. It's about an early announcement of his replacement, and those discussions are going to start very soon.
And yesterday I was with the president in the press conference. He said he has 3 or 4 names in mind. He wouldn't ask them their names. I was shouting over, name the names. He wouldn't name the names. But we should note that already we knew they were going to start this interview process in the fall. That's what Secretary Scott Bessent said to me in April. They have a list of names. They're going to start the interview process in the fall. So already, wasn't the market expecting this all to leak? And by the end of the year, we would probably have a good idea of who the president was going to replace when Powell's up in 11 months' time.
You are going to get a ton of trial balloons. Bring up the names again. Bring up those 5 names, and we can just go through them one by one and start thinking about some of the potential successors, replacements for Chairman Powell. Think about this. You are going to have a ton of trial balloons over the next 6 months or so, and the market will get a vote on this long before the Senate does. And that means some of these names are far more credible, viable than others.
And what that means is, in terms of that trial balloon, isn't just the front end of the yield curve. It is the long end of the yield curve. And this is what I am particularly watching. If you get someone who is thought of as de facto dovish in a political manner, watch that long end yield rise. Watch the sense that people are not going to have as much confidence in the credibility of U.S. debt markets. If you see someone who seems like they are adhering more to an economic framework, then you could see the whole yield curve come down. And that, I think, is what people are watching.
The market perception is going to be really important here. Who is the more credible candidate? Who is the more credible candidate inside the FOMC at the Federal Reserve, which is why the likes of Neil Dutta of Renmac is really pushing Governor Waller quite hard.
Right, and he thinks that Governor Waller is someone that is credible to the market, but also is dovish in this sense right now of what we're dealing with in terms of tariffs. What did he say the other day? We haven't seen the tariff impact on inflation, so why are we on hold for the past 6 months? Speaking of Neil Dutta as well, by the way, Breitbart is floating his name to take a seat on the FOMC. So next year, there's going to be a lot of musical chairs.
I'm sure Neil likes that. Neil, if you're out there, good morning. If you're out there at the Federal Reserve, good morning to you too. Later on this morning, the San Francisco Fed President Mary Daly joining this program, 8:45 Eastern Time. So look out for that conversation a little bit later. Coming up this hour, Sharon Bell of Goldman Sachs with stocks stalling near record highs. Alex Nowrasteh of the Cato Institute on President Trump's search for the next Fed chair, and the former Trump trade official Kate Kalutkiewicz on the countdown to the tariff deadline. We begin this hour with the dollar weaker. Following a Wall Street Journal report that President Trump is considering announcing Powell's replacement earlier than expected. Sharon Bell of Goldman Sachs writing, given concerns about dollar exposure and high concentration in U.S. equities, we see a structural case for more allocation to Europe. Sharon joins us now for more. Good morning, Sharon, and welcome to the program. I want to go back to some words from Chairman Powell earlier on in the week. The big question for him, who pays the tariff? What's the base case for you and the team at Goldman?
In terms of tariffs, I mean, we do think that when the 9th of July comes, it will come and go, and the tariff pause will continue. We think that we haven't reached a conclusion between the EU and the US. But ultimately, yes, we do think that that Europe will see some tariff on the goods that it's sending into the US. Although, who pays that? That's a deeper question. I think some of it will come through in US inflation, quite clearly.
And that means it could come through US consumers. And Sharon, with that in mind, does that shape your view on how you want to allocate to equities, Europe versus the US, based on who's going to absorb the shock? The consumers, companies, which companies on margins, the US versus Europe?
Yeah, so I think the thing for me with the tariffs, and in fact with recent policy in the US, is it's created more uncertainty. And this is one of the elements that's pushing down the dollar. And that the dollar falling is really focusing global investors' minds on, do I want to have all my assets in the US where I am very exposed to the dollar, or do I want to diversify across different assets where I've got different currency exposures, etc. So on the one hand, the dollar coming down and the uncertainty regarding US policy is pushing people to think about Europe, to think about other locations for investment. On the other hand, though, of course, a weaker dollar and a stronger euro, stronger sterling is a drag on European companies' earnings. A lot of them have overseas earnings, and when they translate them back into euros or sterling or Swiss francs, etc., they're going to see a hit on that.
Sharon, there are two ideas that are conflicting here. There's a question about the credibility of U.S. policy and what some of the trade wars are going to do in terms of inflation, in terms of growth in the U.S. And then on the flip side, there's the AI story, which is centered in the United States, to a lesser degree, arguably in China. And this is the reason why people are saying that it's such an attractive time to go into U.S. equities and at a discount if you're buying from overseas and you have a stronger currency. At what point do you buy into that story, given how much European assets have already rallied?
Yeah, I mean, we are increasingly getting this question from clients, both on the sort of signal that you get that European growth isn't going to be still that strong this year, and Europe doesn't have the tech exposure and the growth exposure that the US has, and the fact that the Mag 7, the AI exposed stocks have rallied and done so well in the US more recently. Look, I'm absolutely not against AI, not against technology. I think the Mag 7 are a great group of companies in terms of they've got brilliant balance sheets, they've got ring-fenced businesses, they're investing a lot in growth, etc. So I think their growth potential is still very much there, but also quite well priced as well. And I just think there's a case for diversification, given how concentrated, when you invest in the US market, you are in that one theme, really.
The flip side of this, Sharon, is that as much as people want to get excited about the euro and the ongoing strengthening of the shared currency, there are a lot of policy questions there as well. In particular, some of the fiscal spending that will be deployed for infrastructure as well as for defense spending. There also is a question just about how much they can get their act together to generate growth and the inflationary pressures that are still present. What makes you think that the euro can keep appreciating, given that a lot of the uncertainties in the U.S. have already been priced in?
Yeah, I think, honestly, if I look at sort of fiscal spending and defence spending in Europe, I do think it's going to grow quite a lot in the next few years. All the policymakers are signalling that way. And actually, we had the German sort of budget meeting this week that, if anything, we upped our numbers on, brought them forward a little bit on the commitment to fiscal spend in Germany. So I definitely think the commitment is there to spend a little bit more money. I think on the inflation front in Europe, it's much more subdued than in the US. Growth is a bit lower in Europe. Other than the most recent spike, energy prices have been coming down a bit. And of course, the strength of European currencies is pushing down on European inflation as well. So look, there's still uncertainty with respect to Europe. And Europe is notoriously late when it comes to spending fiscally. But I think that's already well known by most of the investors we speak to.
Well, most of Europe delivered yesterday, Sharon. I was at the NATO summit. 5% of GDP is going to go to defense. But is that actually going to help European equities, given the fact that if you're looking at hardcore defense, a lot of that money is going to be coming into the United States?
I don't know. I think this is something I hear a lot. But if you look pre the invasion of Ukraine, something like 2/3 to 80% of defence spend that Europe actually did was in Europe. You have very large defence industries, particularly in France, Italy and the UK. Europe does spend a lot on defence, and not just old stuff, but also new stuff, satellites, infrastructure, technology, drones, etc. Europe will spend on all those types of areas. Also, if you look at the funding Europe's now putting into place, so the EU-level funding, EU-based finance, there is a requirement that if you're going to access that, you have to spend 2/3 of that in broader Europe rather than outside. So, yeah, absolutely some of it will leak outside. Europe needs to spend quite a lot in the next few years, and inevitably, the US has a very big defence industry. You can get certainly assets from there, but I think a lot will also be spent in Europe.
This has already been signaled early on this year. How much of this defense spending is already priced in?
Well, if you look, we have a group of companies, our defence basket. It's up something like 500% since Russia invaded Ukraine. It's up around 90 or 100% year to date. So it's done extremely well. And I do get a lot of pushback from clients saying, wow, this stuff is surely already priced now. Looks, on a valuation basis more expensive. If you compare it to its growth, though, if you do what we would call a PEG ratio, valuation versus growth, then it's on around 1.5, which is similar to US defence, actually. So if you think you can get this growth, it's not all that expensive. One thing we are suggesting is that people look beyond just the pure defence companies, look towards fiscal infrastructure more broadly or supply chains of defence, etc. So diversify exposure now that these have done quite well.
Sharon, super thoughtful as always, and good to hear from you. Sharon Bell there of Goldman Sachs on the US versus Europe. On the US side, lots of data this morning. Look out at 8:30 Eastern time for tons of economic data from this side of things. Look out for initial jobless claims too. The estimate in our survey at the moment, 243,000 the previous week, 245. That drops at 8:30 Eastern time. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Yahara Anand, who has more. Hey, Yahara.
Hi, John. We start with today's top story. The Wall Street Journal is reporting that Trump may announce Fed Chair Jay Powell's replacement as soon as September, sparking speculation that rate cuts will come sooner and go deeper than markets had priced in. The president said yesterday he has 3 to 4 people in mind for the job. Trump has called on Powell to lower rates by 2.5 points. Meanwhile, Shell is denying reports it's been actively considering making an offer for BP. The company said it has not made an approach and no discussions have taken place with BP, refuting an earlier report that 2 of Europe's biggest companies were in talks to merge. Shell's statement means it is bound by the UK takeover code, largely preventing it from submitting an offer for BP for 6 months. And shares of Nvidia are up 1.1% in the pre-market after closing at a new record in yesterday's session. The AI darling shares have risen 60% off an April low, a rally that has added nearly $1.5 trillion to its market cap. It has now overtaken Microsoft as the world's largest stock with a market value of nearly $3.8 trillion. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the programme, lame duck, Chair Powell.
I was wondering if you've begun interviewing different candidates for the Fed pick.
Yeah, I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible.
3 or 4, or maybe 5. The latest next with Alex Nowrasteh of the Cato Institute, live from New York City. Good morning. Snapping a 2-day winning streak on the S&P 500 in yesterday's session. Jim Reed over at Deutsche Bank, the smallest move since 2017 in yesterday's session. Equity futures this morning positive by 1/3 on the Nasdaq, up by 0.45% as the rally starts to resume. Under surveillance this morning, lame duck, Chairman Powell.
I was wondering if you've begun interviewing different candidates for the Fed pick.
Yeah, I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. He's an average mentally person. I'd say low in terms of what he does, low IQ for what he does. I think he's a very stupid person, actually.
So here's the latest this morning. The Wall Street Journal reporting President Donald Trump is considering naming Fed Chair Jay Powell's replacement earlier than expected. The announcement could come as soon as September. Bloomberg's Tyler Kendall joins us now from the nation's capital with more. Good morning, Tyler.
Yeah. Hey, John. Good morning. Well, as you're mentioning, the Wall Street Journal has this report, and I'll give you some context here. The first time that Jerome Powell was nominated for the role, he had a 3-month runway to go through the Senate confirmation process. That's considered to be typical. But let's say that President Trump did appoint or nominate somebody by September. That would be an 8-month gap to May of 2026. Now, the Treasury Secretary Scott Bessent had told Annmarie earlier this year that the formal interview process wasn't expected to kick off until the fall, but it is clear that President Trump here would like to get it going sooner. And we know some of the names that are up for consideration, including the Treasury Secretary himself, somebody who by and large has President Trump's trust and is also considered to be a pretty soothing presence for the markets. In fact, our own reporting indicated he was the one who urged President Trump back in April to make clear that he has no intentions of letting Fed Chair Powell leave the post before May of 2026. And that really is the needle that any potential pick is going to have to thread here, navigating President Trump's ire while also reassuring that there's going to be an independent central bank.
Tyler Kendall with the latest down in Washington. More from Tyler later this morning, and Mike McKee's going to be with us very shortly as well to weigh in on this situation. And later, 8:45 Eastern Time, Mary Daly, the San Francisco Fed president, joining this program. Lisa, I imagine she's got some thoughts on this situation.
Yeah, and the increasing politicization of the Federal Reserve and how that affects their decision making. Cheat sheet, probably not at all, because they're looking at the economic data and trying to come up with the best situation possible. I do think, though, your point about the market having a vote is an important one. And right now, we're not seeing the long end of the yield curve rise. We're not seeing yields go up. And that is a good sign, even with dollar weakening. If it were going in the opposite direction, then the alarm bells would start going off.
Out of those 5, there are some very credible names to replace Chairman Powell. Out of those 5, there are also some less credible names to replace Chairman Powell. And when you start to narrow them down, if we start to throw out some trial balloons of individual names, that's when the market's really going to get a vote on this.
Yeah, if you start to have somebody who might just cut for the sake of cutting, not because the economic data justifies it.
Precisely. To build on this conversation, Alex Nowrasteh of the Cato Institute joins us now for more. Alex, welcome to the programme. Do you think we're on course for a shadow Fed chair later this year?
I think that that's very likely to happen. I want to, though, point out this is definitely an improvement over President Trump's earlier statements when he said he wanted to remove Powell early. President Trump was probably chastened a bit by the decision in Trump v. Wilcox, which was a decision by the Supreme Court recently that allowed him to fire the heads of some independent agencies. Now, in that case, it was brought up that, the Federal Reserve is kind of an independent agency like this. Does this mean if Trump can fire other heads of independent agencies, he can fire the chair of the Federal Reserve? And the court said, no, the Fed is special. The Fed is walled off. The Fed is a special institution in American history, like other central banks in American history. So it sort of removed that threat. And so this is a way of Trump, I think, dealing with the court not giving him all the power he wanted, which is vital. I think we all know how important an independent central bank is for credibility and for keeping politics at least at a distance from monetary policy.
To that point, the Treasury Secretary said to me in April that monetary policy was a jewel box that needs to be preserved. But at the same time, Alex, does the administration potentially risk shooting themselves in the foot? Because this could be damaging to the market if they think that this basically impacts their independence.
It could absolutely be dangerous to the market. It could impact the credibility of the Federal Reserve. Listen, Trump is playing a very fine line. He likes to do this frequently on lots of policy issues. There's an enormous amount of uncertainty. You see that in the market's reaction to multiple of his policies. You're going to see increased uncertainty. This is certainly not ideal. I think the ideal situation, given the constraints of current public policy and laws in the U.S., is to let the Fed do its thing and be the independent central bank it has been throughout much of its history in the United States, not try to meddle in these things. But that's not really Trump's way. I think the market understands that's not Trump's way. Fortunately, the Supreme Court and the courts have held Trump back and restrained him, so we have more certainty than we would if Trump had his druthers. However, this is just going to be a very chaotic time, I think, in American governance, and that's going to affect these institutions negatively. And I think the markets have basically priced that in. The economy has priced that in, but we just don't know how much worse it could get or if the courts could rein it in and make it better. It's really an uncertain time in a lot of ways.
Well, based on his cabinet appointments, we do know that he loves an episode of The Apprentice. How will the Senate Finance Committee and the House Financial Services Committee, though, welcome this?
So that is that's a really important point. They will probably, predictably, the Republicans are going to be fine with it. Most of them are going to be fine with it, and the Democrats, of course, are going to be angry. What they're really focused on right now is the debate over the one big beautiful bill. Over taxes and fiscal policy, and it's unclear how that's going to sort out. There'll be a vote very shortly in the Senate about this bill going forward. And that, I think, is really dominating the discussion. And then after that, perhaps you could see things turn to the Fed. But there are a lot of issues that are coming up right now in Congress that could attract their attention at the moment.
I'm so glad you went there, Alex. It seems like we're focusing on the next Fed chair when we've got two looming deadlines ahead of us, the July 4th big, beautiful bill vote that they kind of need in order to avoid breaching the debt limit. And then there's this question of how the negotiations are going with tariffs. How confident are you that they are going to get that bill passed in time and then keep on track that July 9th deadline for some of the tariff negotiations?
So I think they are going to pass a bill on time to avoid running up against the debt limit. Nobody in Congress really wants to go up to that limit. Even if it's not sort of the final version, they will push something short term to at least not cause a disaster in that regard. So they'll do something, and they'll probably be able to finish it by the fall. In the worst case scenario. But in terms of the other deals, I guess, in terms of tariffs, is the other deal that is looming on the horizon. If you recall, Liberation Day, April 2nd, we had until 90 days for deals. The 90 days run out on July 1st. Kevin Hassett said there's no deals that are going to be introduced until after July 4th, so he's already pushed back that deadline. So I don't think, this is just the unserious policymaking that I think we all suspected it was from the beginning. Instead of 90 deals in 90 days, he's basically said we're going to have to get like 88 deals in 88 hours if you're going to take that timing seriously. I don't think most watchers take it seriously. I don't think the markets take it seriously. I don't think firms that rely overwhelmingly on international trade take it seriously. And I certainly don't think consumers should take it seriously. And you see this reflected in the consumer surveys about confidence. It's not as bad as it was during COVID.
Hold on a second,
but it sure looks like we're there.
In fairness, a lot of people didn't take the president seriously during the campaign when he started talking about some of these levels. And we are going to see tariffs. We have seen tariffs come through. Isn't there a good degree of complacency over what could transpire on July 9th, which is the reason, going back to the beginning of our conversation, that the Fed has said they're on hold because they don't understand exactly what the input's going to be because it hasn't been written yet?
Listen, I think you came back to the defining issue of this administration, which is the uncertainty that has been introduced at multiple levels of public policy by the president, but also by Congress and by a lot of our institutions, which are not functioning as well as they ought to be. Thank goodness for the courts keeping everybody more sane than they should be. But this is a very odd time. It's very easy to be confident about our predictions. Clearly, a lot of people have not been correct in those, myself included. I've been wrong a few times on some of these predictions as well. But I do think that the one thing you have to deal with for the next 3.5 years is President Trump in the White House with an extraordinary amount of power over economic policy, making decisions as he goes, and a lot of them are going to surprise us.
Alex, appreciate your time, sir. Alex Nowrasteh of the Cato Institute on some of the policy issues down in Washington, D.C. How's it shown up in the markets? 6 days of dollar weakness against the stronger euro. Euro-dollar through 117 this morning, 117.20 at the moment. Levels we haven't seen going back to September 21.
And it comes with a lot of anecdotes of big institutional investors who aren't necessarily shifting wholesale or selling their U.S. exposure, but they're adding exposure to the euro region. I just wonder whether we're underestimating some of the punitive aspects of these tariff deals and what that does mean to the United States and how much that isn't fully being priced in yet.
I'm going to take the other side of what Alex was saying. I was not surprised in what the president did. We know from the past, especially when he was dealing with China, he starts from a maximalist approach and then works his way down. And that's what Liberation Day was. The question now is, what does he settle on? It's very obvious we're going to get a 10% ring around the United States in terms of tariffs. But some of the other countries, especially the European Union, does it actually come up? Is it going to be higher?
July 9th feels like a moving target going through the end of June. into early next month. Up next on the program, former Trump trade official Kate Kalutkiewicz ahead of President Trump's July 9th tariff deadline. Plus, Danny Berger with your morning movers as Nvidia posts a new record high. That stock is up at a pre-market by 1.2%. Live from New York, you're watching Bloomberg TV. Inching back towards all-time highs on the S&P 500 this morning, up by 1/3 on the Nasdaq 100, adding some more weight to the rally, up by another 0.5. With 3 hours until the opening bell, let's get you some morning movers and cross over to Danny Berger. Hey, Danny.
Hey, John. $3.77 trillion, the new market cap for Nvidia. It overtakes Microsoft to become the biggest company in the world. And we add to that this morning, reaching a new record high yesterday. Really the rally starting with earnings season, seeing all of these hyperscalers continuing to invest in AI. So shares are up 1%. We also had the shareholders meeting where Jensen Huang, won't surprise you, was very bullish on Nvidia's prospects. Other chip stocks rallying today. Micron, we got earnings after the bell. Really strong set of forecasts. The forecast to the upside on a surprise. Those shares are up 2%. It also won't surprise you why. They say that AI demand is really strong. Given what they forecast, it will be a record year for Micron. Now to the downside this morning, we do have Trade Desk. This is a company that provides an ad tech platform. Basically, you give ads to them. They put them everywhere. Getting a downgrade from Wells Fargo this morning, saying that they are feeling more competition and will feel more competition from Amazon, which offers a very similar product. Its channel checks suggest that customers are willing to give more money to Amazon instead of Trade Desk. So those shares down just under 2.7%, John.
Danny, thank you. Thanks for the update. Danny with the latest movers this morning. On our radar this morning, our top story, the Journal reporting President Trump is considering naming Fed Chair Jay Powell's successor early, with up to 5 names in the running, including Kevin Walsh and Kevin Hassett. Mike McKee joins us now for more. Good morning, Mike. Your take on things this morning, please.
Well, this isn't a news story. This has been bandied about for quite some time. Scott Bessent raised the idea on the campaign trail, and at one point then he backed away from it. It seems to have come back a little bit. I have talked to a couple of those people on that board there, and they have said the president has talked about doing it early, but they caution that this is Donald Trump, so nobody has any idea what he's going to do. But if Trump is really mad at Jay Powell, he may try to do this just to get under Powell's skin.
Mike McKee, as you know, typically people who go through this process, the interview process to join the Federal Reserve Board, typically they go quiet. They don't give broadcast interviews. They don't write op-eds. And I think that could be the difference this time around. Is that what you're expecting?
Not necessarily, and the reason being is a couple of those people, their job is to talk. Kevin Hassett and Scott Bessent represent the administration on the economy, and that's not anything new. When Ben Bernanke was chosen as chairman, he was the head of the CEA, so he was always talking to the press as well. But once the nominee is chosen, then they'll go quiet because they don't want to upset anybody up on Capitol Hill. I don't think anyone would hold against Hassett or Bessent that they're talking about the economy right now because the president expects them to do that.
Talking about the economy is one thing. Talking about interest rates, quite another. Mike McKee with the latest. Mike, thank you. Are they going to go around talking about interest rates? I imagine they're going to go around talking about interest rates.
If they talk about interest rates, then keep watching the reaction of both the dollar and the yield curve. What you are worried about, or what the market is worried about, is financial repression. Artificially capping yields either by quantitative easing or artificially lowering rates in a way that is inflationary or potentially reduces the value of the U.S. dollar in a material way. And that, I think, is what you mean when you talk about credibility and people's understanding of this as an economic tool and not necessarily one that is highly political.
Speaking of credibility, Kevin Walsh was quoted as speaking in a closed-door event. Now, all of these people in closed-door events are going to be, everyone in the audience will be hyper-focused on everything he said. He said, "My fatal flaw is I say what I believe. If the president wants someone who is weak, I don't think I'm going to get the job."
Is that what he said?
That's what he said. But he did go on to say that he wouldn't be shocked if the president made this nomination sooner to, quote, try to make a lame duck lamer or something like that.
Kevin Walsh has hawkish feathers. Let's be very clear about that. It wouldn't really make sense ideologically to appoint Kevin Walsh to the Federal Reserve to be chair, given what the president wants to see.
A lot of people have said that, which is the reason why people are watching some of the rhetoric. For example, Michelle Bowman coming out the other day saying that she could cut rates as soon as July, even though last year she was incredibly hawkish. Again, raising questions.
Another change at the Federal Reserve as well, unveiling plans to change a key bank capital rule called the Enhanced Supplementary Leverage Ratio, which applies to the largest U.S. banks. The Fed Vice Chair for Supervision, Michelle Bowman, saying the proposal aims to reduce Treasury market dysfunction.
The idea here is that the U.S. Treasury market, the amount of debt outstanding, has almost doubled in the past decade. And banks have argued that they have been unable to increase their trading activities and their market making in a commensurate way, given the fact that they have these restrictions. Key question, how much will they continue to buy or expedite buying of treasuries if they do have reduced rules in terms of the capital holding requirements? Unclear. Why would they want to take duration risk right now?
This is just a sign of the direction the Federal Reserve and regulators are heading in, though, right? Isn't it the optics here that's important for a lot of people?
That is the crucial point. And you are making exactly the dead-on important point that this is going to be a wave of deregulation. We haven't fully seen it. And that is the reason why financial stocks have been flying, because people expect more to come.
That's why a lot of people have been constructive, deregulation and tax cuts. The GOP divided on the SALT cap. Can they solve this, address this issue by July 4th, Independence Day? The Senate Majority Leader John Thune still optimistic they can get the bill on the president's desk by early July.
Well, the administration is spending a lot of time on Capitol Hill. Just yesterday, the Treasury Secretary was there. He met with Senator Mark Wayne Mullen, and then together they met with these holdouts in the House when it comes to SALT. Now, Nick LaLota of New York was saying how it was a cordial conversation. That doesn't sound too optimistic to me, but they clearly want to get this over the finish line. One GOP aide has said that potentially they'd keep the cap at $40K, but they would change some of the thresholds of who can actually go back and be able to use that cap. But they're going to have to figure this out. There is no Republican senator from a blue state. The problem is, to get it past the House, they have to include the SALT cap in this bill.
A lot of important deadlines coming up. July 4th, the self-imposed deadline to pass the tax bill. Then July 9th for trade. The president is threatening to double tariffs on Spain ahead of his July 9th deadline for failing to adopt NATO's new defense spending targets. The former Trump White House trade official, Kate Kalutkiewicz, joins us now for more. Kate, welcome back to the program. Can you discriminate against and target just Spain, or does the rest of Europe need to feel the pain too?
Well, it's certainly a challenge given the makeup of the European Union and the way that they regulate trade at this EU level. But I have no doubt the Trump administration can find a creative solution if they seek to target Spain. We've done it in the past through retaliatory tariffs directed at specific markets. So I suspect his team is thinking up ways right now to do so.
What could that look like? What would be on the menu of options for the president?
Well, in the past, we have seen targeted trade actions at specific member states. One specific example, of course, was the retaliation against Airbus, the airplane consortium that the United States was upset was unfairly subsidized. That consortium is led by France, Spain, the UK, and Germany. And so in its retaliation, the U.S. trade representative was able to look at exports that are specific to certain member states. So, with Spain, you might look at certain citrus exports. You could look at wine. There are ways looking in the tariff code to target specific countries.
Kate, what is the status right now from your understanding of what is going on with the European Union? Because approaching this deadline, they said even if the administration keeps the 10% baseline tariff, they are going to retaliate. I'm glad you brought up Airbus, because the European Union in Brussels is looking at retaliating against Boeing when it comes to the United States.
That's right. They have assembled a pretty strong arsenal to come in if they don't get what they want. And if Trump does decide to go ahead and put the tariffs back in place, I think it depends on who you talk to around how the negotiations themselves are going, and reflects this problem between the United States and the European Union when it comes to these types of trade negotiations. What we have seen in the past is that if you get bogged down in the details, you are really going to struggle to find an outcome. Now, what we've seen work, of course, I see the images here of President von der Leyen and President Trump, is when the two leaders get together in the room, they could emerge with a very high level agreement that satisfies the president and enables the working level negotiators to keep going. That is the only outcome I see actually working here.
So in other words, kick the can down the road. It's either kick the can down the road on July 9th, or else we're going to be mired in a whole lot of confusion and potentially trade war types of dynamics that could disrupt markets.
That's exactly right. And it's what happened during the first Trump administration when he threatened tariffs on the European Union. The then Commission President, Juncker, came in, offered to buy soybeans, offered to buy LNG, and kick the can down the road. And so we do find ourselves in that same situation, same concerns. But, if the member state reps, German chancellor, for example, coming out last night saying we have got to take care of this, can convince the commission president that she needs to offer some of these high value concessions, we may be able to kick this can down the road.
Kate, I want to understand the framework of what's a credible argument with the Trump administration when it comes to reducing some of the tariff load and what isn't. Japan's chief trade negotiator came out in the past 24 hours saying that the country can't accept the 25% tariff on its cars, considering that it makes more cars in America than it exports to the country. Is that a credible argument that will actually be effective in reducing some of the levies?
I don't think it is, because if you look at the justification for the car tariffs, the justification is to promote manufacturing in the United States. So the president has repeatedly stated the only way to avoid those tariffs is to move manufacturing to the United States. He has argued, I think, quite consistently that this is working, pointing to all of these investment decisions by foreign companies, not only in the auto sector. So I don't think that justification makes a lot of sense. The Japanese, I think, have other tools here to offer. We saw it in the case of the agreement with the United Kingdom. Commitments, again, to buy U.S. agriculture. Largely, I think we'll see a push to increase defense spending, as we saw the president succeed in the NATO talks with Europe. So foreign leaders really need to be creative, I think, in terms of what they're prepared to offer. It's not always a direct line between sectoral arrangements.
Kate, when it comes to the timeline, are we going to see any deals before July 9th?
Well, I sure hope so. I mean, I think that the White House and the president's surrogates are certainly laying out the likelihood that we would see a delay, and a delay based on progress. The connection yesterday or the day before from Kevin Hassett to the big, beautiful bill also shows me that they're using this as leverage to get some of the Republican holdouts in the Senate who are pushing for deals to move on the tax bill. So all these moving pieces signal to me that the president will provide some delays. The question for me more is around the trading partners that were assigned reciprocal tariffs but have not really had their turn at the negotiating table with the Trump administration. So I think in some cases we have to take the president at his word that some of these tariffs are likely to come back.
Hey, Kate, great to get your thoughts on the programme this morning. Thanks for joining us. Kate Kalutkiewicz there, the former Trump trade official, on just how interconnected July 4th and July 9th seem to be.
Yeah, I love this sort of fungible idea of we can offer you a benefit on the tariff side for your state, and then you sign off on the bill, and then you sign off on this later, and then you can sign off on the Fed share. It's this ongoing negotiation. Then tell us to get a little bit cooler because it's been too hot.
The president is constantly trying to look for leverage, whether it's with foreign partners within his own party in Congress. But if there are no deals for a host of countries that they haven't actually gone to the table with, as Kate Kalutkiewicz was talking with, then the president says they're just going to get a letter. There's going to be no engagement. It's just going to be, here's the letter, here's your new tariff rate. I agree, Liberation Day was too high, but this is what you're going to pay. And I don't think anyone is getting below 10%.
You're still complaining about the heat?
Well,
is that what that was?
Yes, I am. I'm sorry. It was still disgusting yesterday.
Doesn't it start to break today?
It starts to break. I mean, honestly, it was pathetic.
It's so nice in the Netherlands.
It was pathetic.
Yes. Well, and I worry about the Penguins. What kind of trade deal are they going to get?
Oh, right. OK. All right. You're right to worry.
Right?
Maybe their conversation hasn't started.
They're going to get a letter and they're going to say,
sure, they're terrified. Do you want to do that again?
Give that a miss. Pass.
OK, let's move on. Equity futures right now in the S&P, positive by about 1/3%, with an update on stories elsewhere and some breaking news. With your Bloomberg brief, here's Yihara Anand. Hey, Yihara.
Hi, John. The Treasury says it's nearing a deal that could make the so-called revenge tax irrelevant, potentially offering relief to investors worried about punitive tax measures. The revenge tax provision in Trump's tax bill would impose a levy on companies and investors in countries the U.S. claims have imposed unfair taxes on American tech. Meanwhile, President Trump says the U.S. and Iran will meet next week, but he's casting doubt on the need for a diplomatic agreement on Tehran's nuclear program. That's because he says the U.S. strikes on Iranian nuclear facilities obliterated them, setting back its atomic program. His team is expressing hope for a comprehensive peace agreement with Iran. And former Barclays boss Jess Daly lost the legal battle to overturn his ban from the Citi watchdog over his relationship with Jeffrey Epstein, all but ending his attempt to rehabilitate himself in the British financial services industry. That's your Bloomberg Brief. John?
Yahara, thank you. More updates on that story in the next couple of hours. Up next on the program, the consumer under pressure.
Someone has to pay for the tariffs, right? So we haven't seen it in the price data yet. It's too soon to know exactly where it shows up. But if we're not seeing those big price increases being passed on to consumers, I think that's telling us the consumer is weakening.
In just a moment on consumer confidence, Dana Peterson of the Conference Board, live from New York. This is Bloomberg. Equities at the moment firmer by 0.33%. On the Nasdaq 100 up by 0.5. Just a sneak peek of the bond market for you. A lot of focus at the front end of the curve. We've talked tons on this program about how anchored the front end is around this Federal Reserve that's not going to do anything anytime soon. The 2-year yield's at 3.75 now. It's just breaking away, pulling away from 4%. And I would say we have broken that anchor. We're down 3 basis points. This is the 5th session we've seen the 2-year yield decline. And over that period, we're down almost 20 basis points now, which I think is notable, given maybe the introduction of some rate cuts offered by Governor Bowman and Waller over the past few weeks. But also, you've got to think about also here, Lisa, the prospect of a shadow Fed chair in the next several months too.
Regardless of whether you believe that person A will be nominated, B get through, and then C have an influence over the committee, we are seeing the discussion influenced. If not by that, then definitely by some of the comments that we've heard from Chris Waller and Mickey Bowman. There is almost a 90% chance of a September rate cut currently priced into the market. That is up from about 60% last Wednesday after the Fed meeting.
The economic data important as well later on this morning, 8:30 Eastern Time, jobless claims in focus. Under surveillance this morning, the consumer under pressure.
Someone has to pay for the tariffs, right? So we haven't seen it in the price data yet, so it doesn't look like consumers are paying for it yet. Maybe exporters are paying for it, but maybe it's getting absorbed in margins too, and maybe businesses would be looking to cut costs elsewhere to offset that. So I think it's too soon to know exactly where it shows up. But if we're not seeing those big price increases being passed on to consumers, I think that's telling us the consumer is weakening.
It's the latest this morning. Concerns about the U.S. consumer ramping up. Economists of the Conference Board writing consumer confidence weakened in June, with consumers' assessments of the present situation and their expectations for the future both contributing to the deterioration. Joining us now is Dana Peterson of the Conference Board. Dana, welcome to the programme. There is some criticism of some of these surveys, not yours, but elsewhere, whether they are economic surveys or political polls. How would you describe what we're learning from the consumer at the moment?
What we're learning is that consumers are still very worried about the future, and they're starting to become worried about the present as well. Indeed, our own confidence measure dipped again in the June reading and is well below where we were in January before the tariff announcements.
A lot of people are looking at your data and your consumer confidence read and the data beneath it, the individual components, the so-called labour differential. And they're pointing to that and they're saying consumers are telling us right now that they don't believe this job market is that hot. And from an economics perspective, that's a decent way of saying, I'm not worried about second-round inflationary effects because you're not going to see this passed on in higher wages. Dana, is that your conclusion?
Actually, no. The labor market is actually fine. What consumers are saying is that it's difficult to find a job right now. It doesn't mean that people are largely unemployed. If we look at the unemployment rate, it's still very low. It's more the case that businesses are on hold. They're not hiring people because there's a lot of uncertainty. And other businesses have everyone that they need because the labor market is more or less in balance. You also have to remember there are a lot of young people graduating from college who are finding it difficult to find a job. Again, because companies are in stasis. So I don't think it's necessarily saying the labor market is bad right now. It is just difficult for people who find themselves unemployed to find another position.
Dana, to pair these ideas, have you ever before seen such a divergence between people feeling bad and still going out and spending money, not necessarily acting as though they feel bad?
Absolutely. We saw that over the last 2.5 years where most everyone was saying that there was going to be a recession. because inflation was rising rapidly and the Fed was tightening interest rates. But consumers, even as they complained in our survey, they still went out and spent because they were working. They were also seeing their wages rise at a pretty rapid clip relative to what we saw between the great financial crisis and the pandemic. And, they also had pretty decent savings. And so consumers, even though they were saying the world is awful because inflation and prices are high, they still spent because they had the capacity.
I don't want to get too psychological here or philosophical, but that really raises a question of how important it is to understand sentiment, how important it is to really use some of these gauges as a forward-looking indicator of exactly what people are going to do, of the state of the consumer. How much does this really call that into question? If people are annoyed by things, but they aren't changing their behavior, it doesn't have an economic kind of ramification.
Actually, in our latest survey, we did ask people if they were changing their behavior. And certainly people who had more money were starting to put away savings, just in case. And people who had less money were actually dipping into their savings to purchase things that they needed, like goods and services. So people are changing their behaviors on the margin, but there's still a lot of uncertainty. We don't know what the tariffs are going to look like after July 9th. And certainly we haven't seen inflation rise because companies did stock up and may be selling out of those inventories at a lower price. But certainly when tariffs return and we start seeing inflation rise and consumers probably will pull back, and you may also see the unemployment rate tick up, then that's not a good scenario. And that's what I think consumers are very concerned about right now.
When you see especially the write-in responses, do you see the easing of concern that matches potentially with headlines of the administration talking about deals being done?
Actually, the write-in showed that the top two things that consumers believe would impact the economy were tariffs and prices/inflation. So consumers are watching the news. They understand that tariffs mean higher prices. And so they're putting those two things together and they're saying, look, we're worried about the second half of this year.
Dana Peterson at the Conference Board. Dana, appreciate the update. Thank you. We've all seen the news. It's been incredibly volatile, and where we are today is not where we were on April 2nd, and where we'll be on July 9th is still unclear.
So does this really mean that people feel bad and are acting on it in a material way, or does this mean that we're all in wait and see? I was kind of laughing when you pointed to Jim Reed's comment about the tightest range going back to 2017 for the S&P 500. It was something like negative 0.00000 something or other. And I'm thinking we're all in wait and see. We're all kind of on hold, because how do you make big decisions other than just say, I like chips?
At some time, you've got to make a call. At some point, right? We'll catch up with Mary Daly later this morning, the San Francisco Fed president, 8:45 Eastern time. I think a question for her is, when will you know? How much time do you actually need? Because this could be a feature, as you've said a million times, a feature of this administration, not a bug, for the next several years.
When is data not backward looking? When is it the actual reality? When is it the new normal? And when can you actually say that? Because a lot of people are saying, if you look back, the disinflation would justify a rate cut, especially in light of the increase in the unemployment rate and, frankly, the jobless claims that we're going to get in about an hour and a half.
This sort of trade ideas that potentially you can have more tariffs, left tariffs on, off, like a light switch, Trump is using every single day. We saw him use it at NATO because Spain refused to come to the table to spend 5% of their GDP towards defense. And Trump said, I'll make it up with a trade negotiation. I'll get them back somewhere. So it's really hard to plan when potentially you're going to have a president that is going to use tariffs as a threat, and then some days he's going to deliver.
What is up with Spain? We figured that out.
I mean, honestly, they like China. They want to go there. They also are saying, we're good. We don't need to spend. And guess what? We're fine. I feel like they're trying to make themselves different, and I'm wondering how this is going to go.
Europe wants to complain about the US not being a reliable partner when it comes to Russia and Ukraine, and then Spain goes around behaving the way Spain does when it comes to China. Spain
said they're not compatible with some of the larger goals. But again, this goes to the question of, you're going into the euro instead of the dollar. Okay, with or Spain?
117 right now on euro dollar. Up next, what would you do on your birthday? You'd come on Bloomberg TV.
Amen.
Jim Zelter of Apollo, happy birthday. Joins us next. Bloomberg's Tyler Kendall, Mike Schumacher of Wells Fargo, and Russell Brownback of BlackRock. Join us in the next hour, a stacked hour of Bloomberg Surveillance.
also seeing a lot of macroeconomic volatility.
The economy is growing in an interesting way, in a different way that the official numbers are not picking up.
The U.S. is kind of handcuffed in what it can do because it can't really afford inflation.
The Fed has been excessively data dependent.
At some point, they're going to get pushed into cutting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning to you all. Your scores look like this on equity futures. On the S&P 500, positive this morning. Positive largely across the board, up 1/3% on the S&P. On the Nasdaq 100, adding some weight to the recent rally. At or close to all-time highs in this equity market stateside, up another 0.4%. At the front end of the yield curve, things are starting to get really interesting. The two-year yield backing away from 4%. 375 this morning, down another 2 or 3 basis points and lower over the last 5 sessions, as maybe we start to open the door to rate cuts over the next several months, and we start to consider this from the Wall Street Journal. The President of the United States maybe naming Fed Chair Jay Powell's successor a little bit earlier than expected.
So there are a couple of ideas here embedded in what you're talking about. With President Trump, there is this theory that he could nominate someone as early as September or October to be the next Fed chair, even though Chair Powell's term does not end until next May. This would present a sort of influential voice that could counter Powell, that could potentially cause sooner rate cuts. And then there's the economic data that has been softening. So these two interplays raises a question of how much of the market action is political and how much is actually fundamental about the economic data.
From the market perspective, this is an improvement on firing the Fed chairman.
Correct.
So there's that. From the market perspective, by the time we get to September, the Federal Reserve might already be doing what this president would like to see.
Exactly. And he has interest rates on his mind and he wants to see them lowered. He continuously says that, whether it's 1 o'clock in the morning or to reporters yesterday in front of us at NATO. He constantly is thinking about interest rates and he wants them lowered. So now he's thinking about who is going to fill this role 11 months out. The Treasury Secretary told me the interviews will start in the fall. But once the interviews start, you know that a bunch of names are going to be floated. And this is classic Trump. He loves The Apprentice. He did this with the Treasury Secretary race. He did this with a number of cabinet races. He wants to drum up support, and you're going to see individuals maybe write some more opinion pieces, as we saw from David Malpass, maybe go on some more programs, because now it is actually a race to get the attention of one man.
Bring up the 5 names. Go through them. Already, everyone around the world making a decision. Going through these names one by one. Who do I believe is economically, intellectually independent from the President of the United States? Who am I going to sell bonds on? Who am I going to buy bonds on? Who do I sell the dollar on? Who do I buy the dollar on? I've got my opinion. You don't want to hear it. I think a lot of people have already established their views on this situation as well. And that's why we keep saying the market will have a vote on all of this way before, long before the Senate has a confirmation hearing.
Who says that we don't want to hear your opinion, John? Lay it out. I know you've got a PowerPoint. Come on, this person. Look,
I'm avoiding it this morning.
I think that's wise. I think for myself, I'm going to avoid it as well. There is a question, though, of how much the market is going to view this as financial repression versus just taking a slightly different interpretation of economic data in still a prudent and economic way.
We'll spend some time on this through the next hour or so. Coming up on this program, through the next 60 minutes, we'll catch up with Jim Zelter of Apollo on deal making in an era of policy shocks. Mike Schumacher of Wells Fargo on increased defense spending weighing on bonds, and Russell Brownback of BlackRock as traders boost bets on Fed rate cuts. We begin this hour with the dollar slightly weaker as the Journal reports President Trump is toying with the idea of announcing replacement for Fed Chair Jay Powell earlier than expected. Joining us now for a long discussion, Jim Zelter, the president of Apollo Global Management. Jim, good morning.
Good morning, Jonathan.
And happy birthday, sir. It's good to see you.
Thank you very much. I appreciate it.
We
Great
won't
day so far.
spend too much time on the Federal Reserve, but I do want your reaction to this Journal piece overnight.
Well, I think that the president's already won. It's a great distraction of headlines. I personally don't think he's going to name anybody too early because right now he's in the catbird seat of blaming without accountability, which is classic Trump playbook. So I think the fact that we're talking about it is interesting. It's a great diversion from the reality. I think he does, and there's no doubt he wants rates lower. That's what's part of his plan for many, many years, and that's how he doesn't like to pay debt, and he likes to pay low coupons on it. But the fact that, I just don't think that if you're Trump right now and you take his playbook, he'll make this a conversation, but I don't suspect he's going to do anything premature because he's able to put blame on the current resident of the Fed, and he likes to be in that position.
Your words, blaming with accountability, without accountability.
Yeah.
Is there something you think he should be accountable for?
Well, certainly I think if you think about what's going on in the last 3 or 4 months, the issues of tariffs, it feels like that's a little bit on the sidelines right now. I know we haven't resolved it, but the marketplace has absorbed the idea of a 10% plus or minus tariff, maybe a little bit higher. But to Trump's benefit and the administration's benefit, the market has absorbed that and moved on. The issues about the Middle East and all the challenges of foreign policy, there was a lot of action last 10 days ago and a week and a half ago, and now that has been sort of absorbed in the marketplace. The big elephant in the room is still our deficit issue. You guys have talked about it quite a bit. It's obviously the topic of appropriate conversation. And so I think that is an important topic that still remains. But, you know, we talked earlier in this year about the decline of U.S. exceptionalism. I think Mark Twain was right, that my death is a bit premature. And certainly the market has moved on. So I think the tariffs are a little bit off on the side. The foreign policy issues are a little bit off the side right now. The deficit issue is a real issue. We could talk a little bit about what's going on with the dollar. I personally think what's going on with the dollar, I think there was a lot of investors around the globe that invested in U.S. assets, and they made money both ways, on the currency and on the underlying assets for almost 10 years. And they turned around and they found themselves really unhedged. And I think you're going to see some pretty good numbers out of the big banks this quarter because investors around the globe have been rushing to hedge their dollar exposure. But I think it's a 10-year catch-up that people just didn't hedge their portfolios in massive scale. So I don't look at this dollar decline as I look at it as more of a technical factor than a long run impact on the health of the U.S. economy.
There's a lot to unpack there, including the breakout of the hedging profits at some of the big banks, which we'll all be now looking for. To build on what John is asking about, is the Fed on the brink, I don't want to say of a policy error, but of being too late, kind of to build on what President Trump is accusing him, because you are seeing the weakening in the dollar accompanied by the biggest negativity, the biggest increase in downside economic surprises that we've seen in a year.
If you look at the Bloomberg page on rates of the G7 economies, other than the UK, we're the outlier in terms of where our 10-year yields are and our yield curve is. You know, I sit in my seat and I see a variety of inputs that some tell me the economy is slowing down a little bit with consumers. Some tell me inflation is still a little bit more represented in the economy. We see inflation around 3.5%, and I don't think it's obvious that the Fed should be cutting right now. I think it is a very legitimate question to be asking what's the trajectory of the Fed activity. And so I don't think it's a slam dunk decision. I know the market, the futures would tell you 3 cuts in the rest of the year, 3.5 cuts. Torsten and I are a bit skeptical on that. We see what's going on, and I think there's maybe 1 cut. Your basic question, is the Fed conversation a really important one right now? It is. I have a view that rates are going to be a little bit stickier and higher in the U.S. than people think. We've had that view for quite some time. So it is a good question for the administration to have right now, but I'm not sure that's the primary question for the market.
One of the reasons why people keep asking this question is, would the Fed be considering cutting for the right reasons or the wrong reasons? The right reasons being disinflation, which you reject, but the wrong reasons being because we are seeing a weakening in the labor market, as we see as the increase in jobless claims. What's your sense of that based on what you've seen with portfolio companies, what you've seen with your investments? Is that valid?
Yes, I think long term, you can't argue with the long term deflationary impact of technology and AI. That is out there. Now, whether that's 6, 12, 18, 24 months, there's a massive deflationary impact from that activity. I just don't think it's on the center of the plate right now in the markets. It's out there. And I think that you're fighting with short-term still supply interruptions, hiring interruptions, and some short-term challenges that are inflationary versus a long-term backdrop of deflationary trends because of AI around the globe. I think that's sort of the center of conversation. When I'm back here in 2026 and 2027, I think rates will probably be a bit lower because of the technology impact. But I think in the next 6 to 9 months, I don't think rates are going to be dramatically lower.
If you'd taken 6 months off and came back to work and looked where the market was, I don't think you'd have a clue anything had happened here. Equities close to all-time highs. Credit spreads are very tight. It's not a market that's screaming out for rate cuts. From your standpoint at Apollo, when you look at valuation, underwriting, any red flags getting your attention at all at the moment?
The economy is amazingly resilient in the U.S. When I was here 3 or 4 months ago, there was concern hand-wringing about the trajectory of the economy. There was hand-wringing about non-U.S. investors, global investors investing in the U.S. I've been all around the world the last 12 weeks. American exceptionalism is front and center back. You talk about where valuations are and levels of equities and rates, they're back. Global investors want to invest in the U.S. They made a lot of noise. They thought they were going to diversify themselves away, and they realized the breadth and depth and the strength of the U.S. economy and the scale of what they need to invest. And the U.S. is the primary place to invest. It still is. So, it's very interesting. I was in Europe a few weeks ago. I was with your folks. I want to talk about that. Amazing things going on in Germany right now. The reality is public markets are the narrative, but private capital drives the economy. And we're seeing it. We've been amazingly active. ED&F last week, Lottomatica, what's going on in a variety of financing. So it's been a very, very busy time, but I'm not seeing any red flags going off. And I want to make sure we talk today about this concern about the private capital, private credit bubble versus just an economic cycle. We're due for a credit cycle, but that does not mean it's a bubble. And private capital is playing a bigger and bigger role. Look what we did last week for ED&F in the UK and Germany. $4.5 billion sterling private capital financing, long duration debt to finish out their nuclear power plant build. Really, really important that we're playing that role.
We'll sit in Europe. Let's just stay there off the back of your travels. So you mentioned ED&F, big sterling transaction. Yeah. Also a big target from you and the team to invest, 100 billion in Germany over the next decade or so?
Yeah, if your leadership journey right now, your goal is to get a 4 trillion economy to a 6 trillion economy. And you are, I was with the administration, you can talk to MERS, they really are embracing the role of private capital along with government spending over the next 5 or 10 years.
They've been so dependent on the banking system in Europe for such a long time. Can they get away from that? Because I feel like I've been talking about this for more than a decade.
Well, I think the evidence is there. If you look at the last 24 months and what's going on with the leading Italian banks, look what's going on with HSBC, look what's going on with Barclays and Deutsche Bank. They're operating in a much different capital regime with a focus on shareholder value, with a focus on ROE, and they're really, not taking all the policy lending on their balance sheet like they had in the past. So they're actually operating the right way. What you didn't really see before is the government really embracing in Germany, in France, in the UK. They want private capital to be part of the solution because they know the government balance sheets cannot do all that's needed in terms of the massive capex of transmission line, of transportation, of AI, of data centers. They know they're behind. So if anything, this administration in the U.S., the memo they sent out about what's going on in the U.S. and Europe stepping forward, European leadership has taken notice. Let there be no doubt. I go to Europe 3-4 times a year. I've never been so embraced as we were 3 weeks ago in Germany and France about the role of private capital in this build-out.
How much is that driven by this U.S. administration?
A lot. I mean, it's clear that they know that the European leadership has, even if you look this morning about how they're stepping up on defense spending with NATO. So I think, when I think about the globe right now, again, tariffs are a little bit off on the sidelines. They're part of the conversation. It's a question of how much, not if or when. And I do think they feel like there's a responsibility that they have for their citizens, because when you look at the last 15 years and where the U.S. has grown versus Europe growth, it's startling. When I got out of college a few decades ago, it was all about Japan. Japan was going to take over the world. It was all about Germany, industrial, taking over the world. That did not come to play, and I know they have a lot of catching up to do. And I just think it's a very, very now. If you read the Draghi letter and what he put forth 18 months ago now, if they followed that all 156 pages in great detail, it would be a watershed economic opportunity. And I think parts of that will come forth. but they're already making moves on securitization, other activities. And to Jonathan's point, the European banks are a bit behind the U.S. in terms of the fundamental focus on ROE and shareholder return and capital efficiency. But I think I don't want to say they're catching up, but they're getting in line clearly. And equity investors have taken notice.
You're going to stick with us. Jim Zelter of Apollo is going to stick with us through the next 15 minutes or so. In the meantime, let's check out the market, up by about 1/3% on the S&P. And let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yih-Tennant. Hey, Yih-Tennant.
Hi, John. The Wall Street Journal is reporting that President Trump may announce Fed Chair Jay Powell's replacement as soon as September, sparking speculation that rate cuts will come sooner and go deeper than markets had priced in. The president said he has 3 or 4 people in mind for the job. Meanwhile, the GOP remains divided on the SALT cap. Earlier this week, Treasury Secretary Scott Bessent met with Republicans to try to resolve their differences. But Congressman Lilota of New York said they are, quote, far from a deal. Meanwhile, Senate Majority Leader John Thune still thinks they can get a bill on the president's desk by July 4th. And Micron shares are rising nearly 2% in the pre-market after the chipmaker posted third quarter results that beat Wall Street estimates. It also gave an upbeat forecast for the fourth quarter. Micron is on track to post record revenue this fiscal year, fueled by strong demand for its AI equipment. That's your Bloomberg Brief. John?
Yih-Tennant, thank you. More from Yih-Tennant in about 30 minutes from now. Up next on the program, Chair Powell's replacement.
I was wondering if you've begun interviewing different candidates for the Fed pick.
Yeah, I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible.
That conversation up next with Bloomberg's Tyler Kendall, plus more from Jim Zelter of Apollo, live from New York City this morning. Good morning. Live from New York City this morning. Good morning to you all. Equity futures on the S&P positive here by 0.4%, up by 0.5 on the Nasdaq 100. A lot of attention on the Federal Reserve this morning. Under surveillance, Chair Powell's replacement.
I was wondering if you've begun interviewing different candidates for the Fed pick.
Yeah, I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. He's an average mentally person. I'd say low in terms of what he does, low IQ for what he does. I think he's a very stupid person, actually.
So here's the latest this morning. President Donald Trump saying he has 3 or 4 people in mind to succeed Fed Chair Jay Powell. The Wall Street Journal reporting the president might announce his replacement earlier than expected. With the latest, here's Tyler Kendall. Good morning, Tyler.
Yeah, hey, John, good morning. So this isn't necessarily surprising, right? President Trump has been ramping up his criticism of Jerome Powell in recent weeks and likely wasn't too happy with the Fed chair's testimony on Capitol Hill. I was there when Jerome Powell reiterated that the central bank is in wait-and-see mode amid so much uncertainty when it comes to this White House's economic policies. And yes, of course, tariffs is at the forefront, but I'll also point out his comments about a shift in immigration policy by this administration that's contributing to a curb in growth when it comes to the labor market. Now, for context here, when Jerome Powell was originally nominated, he had a 3-month runway to get through the Senate confirmation process. But if we're talking about President Trump naming somebody in September, that would be an 8-month gap to May of 2026. Now, our analysts at Bloomberg Economics say that whoever is chosen here will likely have the best chance of getting chosen if they meet 3 main criteria for this White House. One would be loyalty to the Trump administration. The second would be credibility for the markets. And the third would be what they call unconventionalism vis-a-vis the economic establishment. Essentially, the White House would be looking for somebody who wouldn't be afraid to buck the trend. Now, we should say there is, of course, so much uncertainty like many things with this administration, but our analysts are pointing to potentially NEC Director Kevin Hassett as being one of the most likely choices because he could say after he's done with the one big beautiful bill that it's mission accomplished and he's looking for a job outside of the White House.
Tyler Kendall with the latest. Tyler, thank you. This is September. Think about how far away September is and what could happen in between. July 4th, tax bill. July 9th, trade deals. Could be in a completely different position in September.
Jim Zelter said it best. This president has already won because the headlines are this and not all of those issues that are coming up on the floor in less than 2 weeks that are pretty major potentially for the market and the economy.
the president of Apollo Global Management, still with us. Jim, let's continue this conversation. You've talked about macro paralysis in the past. I don't see any sign of paralysis when I look at, say, high yield issuance, when I look at activity. Do you see paralysis at all?
I don't. And back to this last topic, I mean, as you point out, Lisa pointed out, the two big topics that they need to really deal with right now is the tariffs on July 9th and the big, beautiful bill. But we're not talking about that this morning. We're talking about a Fed chairman in 9 months. And I look at everything through what this president has been in the past. As a real estate developer, it's all about location, location, location. The Fed pick will be about loyalty, loyalty, loyalty. Let's not get confused. There isn't paralysis in the market. As I mentioned before, the public markets are the narrative. The private capital is really the driver of the economy. A lot of activity going on in the U.S. on refinancing, in Europe on the global industrial renaissance. So we are on pace to have our busiest quarter in origination that we've had in a number of years. A tremendous amount of activity across our equity platform, our infrastructure platform, our credit platform. So I do think there was a lot of hand-wringing, as I said, 3-4 months ago. And I think that's now on the sidelines, maybe not on the narrative, but certainly on activity.
Is that activity in lieu of some of the deals activity that we were expecting? Was it sort of expected to be the deals and the IPOs and the big boom for the banks, and instead it's Apollo coming in and doing a lot of financing deals in the back?
Well, I think two things. I think at the beginning of the year, people projected that the busiest folks on Wall Street would have been the ECM, equity capital markets teams, and the M&A teams. And while they've both been busy, the busiest folks have been the rate hedging and derivatives teams because of what's gone on in the dollar and concern about tariffs and such. But it's an interesting backdrop. Even listening to your program this morning, the fundamental economy is doing fine. It's doing well, maybe not to the growth expectations that people had earlier this year, and we'll come out somewhere around a 2% growth with about 3% inflation. But whether it was NVIDIA, whether it was Micron, a lot of CapEx still going, a lot of companies in the AI space raising tremendous amounts of capital at high valuations with long list of investors coming in. And the activity, as I said earlier, what's going on in Europe right now about that industrial renaissance, it's still going on. So again, I think there's the headlines and then there's the reality of the underlying economy and the role of private capital, which is a much, much bigger, longer term story.
How do you think you're going to decipher the reality versus the headlines when it comes to New York City? You have a huge company here in New York, and a lot of people are concerned about a democratic socialist becoming the mayor of the city.
It's probably one of the most complicated jobs in the world on the political stage in terms of bringing a variety of the 5 boroughs together, the business, the community, the unions, all the folks that make New York the special place it is. As I mentioned before, 3 out of every 100 college graduates a year come to New York in the U.S. It's still the magnet of talent and ambition. So when you see somebody that on the surface does not appear to have a long resume of leadership and making tough decisions, really concerning. And I think that we'll see now just winning the primary, while in the past it might have been the litmus test for being the mayor. I think there's still a long time coming until November.
Build out the office in Florida. Is that what you're hearing?
Texas. It was the most diplomatic response ever.
We are.
Look at the resume.
We are a New York company.
There we go.
We are determined to be here. I'm determined to be here. Our leadership's determined to be here. We have people in the office 5 days a week.
He's running.
It's no. I'm not running
Jim.
for mayor.
Jim, it's good to see you. Happy birthday, Jim Zelter of Apollo. Some great hires in the last few months over at Apollo as well. Brian Weinstein, friend of this show, fantastic over at Apollo now. Jennifer Lin as well from JP Morgan.
We will get both on in the next several months along with Eric Needleman.
I'm sure the banks are thrilled with you guys. Up next on the program, Mike Schumacher of Wells Fargo on increased defense spending weighing on bonds, plus Danny Berger on the latest movers. We'll take a look at AMD. "60 minutes from now, some important economic data. Look out for jobless claims for another read A refresher on what's happening with the labour market here stateside. Stateside in the equity market, positive by 1/3% on the S&P, up by 0.5 on the Nasdaq 100. Let's get you some morning movers before we get to that opening bow. 2 hours away is Danny Berger. Hey, Danny.
Hey, John, some earnings to work through. We got Walgreens Boots moments ago. Shares are up only 1/3% despite the fact it was a healthy beat. They are seeing a more successful turnaround, but just want to be very clear that this stock does have a ceiling on how much it can move in, a floor, because it is going to be taken private by Sycamore Partners at the end of the year. But for what it's worth, solid earnings from Walgreens Boots also is a positive for other stocks like CVS. We also heard from McCormick. This is the spice maker that you so often see in grocery stores. The expectation was that this was another company that would come out, have to downgrade its outlook because of the tariff hit, because of higher input costs. Instead, what we got from them was a hold and a no change to their outlook. That's enough to send shares up almost 5%. They said that they have the capability to offset and mitigate any tariff costs. Now, there is one sector, though, that is clearly driving the market this morning, and that is chips. Chip makers are off to the races. A couple things going on here. NVIDIA hit an all-time record yesterday, became the biggest company again. Those gains continue. Micron also a solid day for it after it reported earnings yesterday, where again, AI is the thing that is lifting all boats in this tide. And you see their earnings getting really positive output from analysts and upgrades there. So you're seeing other companies like AMD, like Broadcom, all of them rallying in the pre-market, John.
Danny, appreciate the update. More from Danny in the next hour. On our radar this morning, President Trump saying the U.S. will hold talks with Iran next week. The president telling Annmarie just yesterday his administration has no plans to go easy on the regime.
You said China can now continue to purchase oil from Iran.
Yeah.
Are you giving up on your maximum pressure campaign on Iran?
I'm not giving up. They're going to need money to put that country back into shape. We want to see that happen. China is going to want to buy oil. They can buy it from us. They can buy it from other people. But you're going to have to put that country back into shape. It desperately needs money.
You in the blue, now in the green. It's good to have you back. Talk to me about what your big takeaways were in yesterday's presser.
In that moment there, it still feels very ambiguous. I remember when this administration in February put out a national security memorandum talking about the fact that it wasn't just the nuclear program they were going out with the IRGC, but the fact that they could sell this oil, they take those funds and give it to the proxies like Lebanese Hezbollah and Hamas and Houthis in the region. The president yesterday said, I could stop it if I want. They're going to need the money to put that country back in shape. They desperately need money. And then he has meetings with them, his team, next week. So are sanctions now back on the table and they're going to loosen up this idea of maximum pressure?
Yeah, this is difficult to understand. As you know, the consistent criticism of the previous administration, and I think justified in the minds of many, is that they didn't enforce the tariffs. They didn't enforce these sanctions, rather, on Iran and allowed them to build up this money, allowed them to build up these proxies. I'm sure it's not what they wanted, but that was the outcome. That was the criticism from the incoming administration. So it's confusing that this is the path the president's willing to go down.
Especially since after sanctions on tankers, owners, brokers, and traders, the U.S. blacklist now covers more than 2/3 of the 150 vessels that have handled the shipments of Iranian crude this year. That's what the data says. So they have gone after all of these flagged ships that go to China. China's buying all the oil, but they're doing it through, say, Malaysia or the UAE. But now the president is saying China can keep buying the crude, which makes you think that they're going to loosen up potentially on maximum pressure. So are they just going after the nuclear program? Is that all they care about? Or do they actually care about the money that this regime is giving to proxy groups like Hezbollah and Hamas?
Watch this space. It's been quite a ride in the oil market this morning. Brent and WTI trading as follows after getting absolutely whipsawed into the 80s, back down into the 60s. Crude has been all over the place.
Yeah, and that's what we've seen, where we saw actually a little bit of a rebound over the past couple of trading sessions. Honestly, to me, this is the big question. How do they crack down on a nuclear program without some other constraints, given that we're still looking for those 400 kilograms of enriched uranium?
Isn't that scary?
It's so scary to me.
Like, that's the number one question. I keep coming back to that.
100%.
Where is it? No one knows.
The IAEA needs to get back into the country. And do you think the regime is going to let the IAEA's inspectors back in? I think that is a big question we are waiting to understand.
WTI, 65.20. Brent crude, 67.93. Let's turn back to that story from the Journal reporting President Trump is toying with the idea of naming a replacement for Fed Chair Jay Powell earlier than expected. Powell's term runs for another 11 months. Trump reportedly exploring an announcement in September or October. And to your point, that's a lot of runway between September and October all the way out to May.
Neil Dutta put out a note today, and he said you could argue that there already is a shadow Fed, and that would be Chris Waller. And you could see the disproportionate impact that his comments have had on the market as really acting as such. If you take a step back, and this isn't very popular for someone who has to talk about stuff all day, every day, but I kind of feel like maybe we're giving this a lot of air when essentially this is the president wanting to get lower interest rates amid a lot of economists that agree with him and economic data that actually points to already a rate cut in September. So it is a distraction to build on what Jim Zelter was saying from some of the other issues.
Totally agree with you. I said the same thing in the last hour or so. By the time you get to September, they might already be doing what the president wants them to do.
Totally. So are we making a mountain out of a molehill, given the fact that this is a president who makes headlines pretty much every day, and we already know what he thinks of Jay Powell?
Well, if Jay Powell does a U-turn, does that mean he gets an interview? Is he potentially now back in the docket on the list?
He was appointed by President Trump. This is also really important to remember. He is a Trump appointee himself. So exactly to that point that Jim and yourself that you were talking about, loyalty. How much is that really going to be at the front and forefront? What does that mean?
So is Waller, so is Bowman.
Exactly.
And I think you might be happy with the two of them.
And Bowman was mentioned in the Breitbart report. Not in the Wall Street Journal report, but in the Breitbart report. So there might be actually more names than we are understanding.
We'll be playing this game repeatedly for the next 7 months, something like that. OK. Wanted to squeeze in this story. Shell saying it has no intention of making a takeover offer for its fellow oil giant BP, refuting an earlier report about active merger talks. Shell saying it hasn't, quote, made an approach to and no talks have taken place with BP with regards to a possible offer.
I went down a rabbit hole this morning about UK rules around mergers and how this actually takes them off the table for 6 months because now they have to wait that long before they can make the actual bid because there was a formal denial. What is up with that? Can you just explain what that is?
Well, imagine if you were worried about the price being bid up before you could close the deal.
There we go. OK. All right. So this is the way of doing it. Look, BP has fallen so much, and they've been trying to create a new business other than fossil fuels, even though they're an oil company. And so there's a real question about whether Shell, as also a UK company, will be the answer to a lot of the problems that a number of people have said.
I'm pleased that's how you spent the morning.
It really took me down a path.
Don't waste your time doing that, Bram.
I did. I wasted a lot of time.
I moved on from the UK stuff a long time ago.
I know, but you moved here.
I moved here. Far more interesting. Let's turn to NATO. Member countries agreeing to a defence spending target of 5% of GDP. Mike Schumacher of Wells Fargo writing, just say no to 30-year bonds. Rising defence spending means heavier issuance, meaning pressure on the long end. Mike joins us now for more. Mike, welcome to the programme, sir. Provocative piece, and I think a lot of people will agree with you. And Mike, the interesting thought that you and the team have got is this is not just the United States. This seems to be a global story.
It is, John, and we think it's got legs. So you think about a secular shift in defense spending. We're talking probably 5-10 years, something like that. It's going to have a long time to go. And I get it. There's a lot of skepticism. People say, well, NATO's target's been 2% for a long time. How many countries have actually hit that? Not many. So why would they go to 3.5% or 5%? Maybe they don't get there. But really the point is they go up in terms of spending. And I think most countries probably ratchet their spending up in the next couple of years. So if your runway is 2 or 3 years, you say, well, your average NATO country boosts defense spending by 0.5% of GDP. Do the math. That's a lot of bonds. We think a lot of long-term debt, and I doubt that it's fully priced.
A lot of people have pushed back on the argument that issuance matters. And I know that this is sort of the popular idea. And yet in the U.S., it hasn't, because we've increased our debt dramatically in periods where we saw rates at near zero. So I'm just wondering at what point, what's sort of the tipping point where people become bond vigilantes and pay attention to issuance rather than just inflation?
Yeah, it's interesting. I think issuance does matter. So think about not just nominal rates, but real rates. I agree, inflation's high. That's why you've got high break-evens. But think about your nominal interest rate. Decompose that. Break-even inflation, real rate. I'll give you a couple numbers. So in the decade prior to COVID, the average real rate on a 10-year Treasury was 40 basis points, 40. Today, it's about 2%. That's a massive premium. Issuance does matter. So the market's saying, look, we've got the U.S., which is profligate. It's got 6% something budget deficit. A lot of bonds to come out. We have to charge a relatively high penalty. So I think the market's been imposing that for a while.
Germany is considering this 50-year bond. Mike, who is best positioned to tap their debt markets when it comes to this defense spending?
50 years tough. I remember when the U.S. talked about a 50-year back in the first Trump administration. I personally polled probably 40 or 50 clients. How many buyers do we find? 0. So perhaps the Germans have more luck today, but I think when you look at really long-term debt, it's tough. But I would say in general, whether it's a 50-year or a 30-year, the countries that are best positioned are the ones that are starting with a relatively low budget deficit and low issuance. Germany is the obvious example. When you think about the outstanding volume of boons, it's less than $2 trillion. Just to put that in context, treasuries, you've got $24 trillion. Germany has a pristine credit rating. Germany will find buyers for long-term debt relative to other countries, but probably has to focus more on 20 and 30-year, less on 50, in my opinion.
What is the idea of higher rates for longer? What does that do to valuations over a longer term? We've already seen what that's done to the housing market and sort of the stasis that's there. But do you expect equity returns globally to be substantially lower over the next 5 years, 10 years because of rates that are permanently sort of pegged at a higher level?
It probably makes people think about that trade-off a bit more carefully. And it's interesting. We used to do a lot of comparisons between the equity risk premium and bond yields. The problem is that model has shown the equity market, whether it's the U.S. or elsewhere, to be rich for a long time. But I do think that if bond yields are persistently high, so let's say that the, quote, average rate on a U.S. 10-year for the next 5 or 10 years is 3.5 or 4% instead of 2 something, does that impact the equity market? Probably. Is it something people can trade today? I don't think so. But when you consider longer-term allocations, it probably does play a role and probably eventually makes bonds more attractive.
Mike, some of the naysayers at NATO, though, were saying that this defense spending, this 5% target of GDP, is only because Trump is there. He has a 4-year term. How much is this analysis you have on only because Trump's president, and then potentially in 4 years, they're not going to reach even close to that spending?
That's a great point. That's why we focus really just on the next few years. So for us, we'd say, look, Trump is going to harangue NATO members to spend more on defense. That's pretty clear. He's done it already. He's been successful. Look at Canada. It's going to spend 2% of GDP on defense in the upcoming fiscal year after being 1.3 or 1.5, something like that. So he's already getting that done. So for us, it's not so much about what happens in 2030 or 2035 when who knows is the U.S. president, but if you think about the path for the next 2 to 3 years when Trump will be very visible, very loud, I think it's reasonable to say that most countries in NATO will ratchet up their spending quite a bit. So for us, that's the big impact on the markets. It's much less about what happens in the out years.
My quick final question, a question I think we'll ask a few times this morning. If the next Fed chair is a White House puppet, do we have to introduce some kind of EM premium to the long end of the curve?
Yeah, I'm skeptical about that, John, and here's why. When you think about the nominee, it's pretty clear people want to act a bit dovish to try to get that job, to get the interview, to get the nomination. But once the Fed chair is in place, how much control does the president actually have? Not much. It was a great point. Powell's a Trump nominee, Trump appointee. Can Trump really control what he does? No. So if it's Kevin Hassett or if it's Waller who gets the job, once that person's in the seat, once that person's been confirmed, I think he or she is going to take his own direction. So I'm not super concerned about that right now, but I think the markets might overreact between now and September, October, whenever that nomination comes out.
Appreciate the input. Mike, thank you, sir. Mike Schumacher of Wells Fargo. Important, thoughtful piece on defense spending and thoughtful comments there at the end about the future of the Federal Reserve.
You know, I don't get the sense that people are that fussed about this. And I think your comment earlier that this is an improvement from saying he was going to fire him, I kind of get the sense that's how people are taking it.
I do think there's a difference between some of the names, and I'll leave it at that.
I think you're correct.
All right.
You don't have to leave it at that.
5 names there, and
some are better than
you
others.
figure the rest out. If it's 1 or 2 out of those 5, I think you'll see a very different market reaction to the other 3.
EM, what did you say, presidential puppet? You get EM dynamics?
A White House puppet.
Yeah, White
we'll
House
introduce
puppet,
EM dynamics.
Yeah, and I think that you're right, the idea of financial repression.
Turkey tried this. It causes problems. Other countries have too.
Yeah, U.S., New Turkey.
Yeah, OK. We don't want that. And it's certainly not that right now. Let's be very clear about that. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Former Barclays boss Jess Daly lost a legal battle to overturn his ban from UK finance over his relationship with Jeffrey Epstein. A judge siding with the Financial Conduct Authority ruling that Daly misled officials about his dealings with Epstein. The ruling all but ends Daly's attempt to restore his reputation. Meanwhile, the Federal Reserve released plans to relax a key rule which would reduce capital requirements for big banks. It also allows the banks to hold more treasuries and act as intermediaries in the $29 trillion market. The Fed board voted 5-2 to propose the changes. Bloomberg reported on the potential relaxing of the rule last week. And Israel's central bank governor Amir Yaron says his country's 12-day war with Iran will be a long-term positive for the country. He told our own Lisa Abramowicz, markets show Israel's geopolitical risk has been significantly reduced.
Markets are telling us that Israel's geopolitical risk has been significantly reduced. We're seeing it through the improvements or the appreciation of the shekel. We are seeing it through the reduction in the CDS of Israel. If the ceasefires continues to go on into better economic activity.
Yaron also said Israel's Iran campaign costs the country about 1% of its annual GDP. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, reducing uncertainty.
The question is, who's going to pay for the tariffs? Reducing uncertainty would help, and also just what's going to be the final tariff rate and getting that settled. I think that's the path we're on.
In just a moment, we'll catch up with a very constructive Russell Brownback of BlackRock, live from New York City. You're watching Bloomberg TV. Equities at the moment firmer by 1/3% on the S&P. On the Nasdaq 100 up by 0.5. On the S&P 500 still within 1% of all-time highs. Under surveillance this morning, reducing uncertainty.
The question is, who's going to pay for the tariffs? The ultimate question of it is how much of it does show up in inflation. And honestly, it's very hard to predict that in advance. Reducing uncertainty would help, and also just what's going to be the final tariff rate and getting that settled. I think that's the path we're on.
Here's the latest this morning. Short-term bond yields falling as traders bet the Federal Reserve might cut interest rates in the coming months. Russell Brownback of BlackRock writing the economy heads into this moment with structural strength. 2025 is likely a stagflationary outcome. Russell joins us now for more. Russ, good morning. Good to see you.
Thanks for having me.
Had loads of great feedback the last time you were on, and we were talking about all these shocks we've experienced, the Fed tightening, the regional banking crisis, the trade chaos of the last few months. And you talked about these points of resiliency in the US economy. Just remind us all, what are those points right now?
Well, first of all, when you think about the private sector's balance sheet being pristine, both corporations and households. Secondly, you've got a structurally tight labor market. So the labor market's lost a little bit of velocity, partly due to supply constraints related to immigration, partly due to the uncertainty. But it's not job destruction. It's just a mitigation in job growth. And that's why the unemployment rate hasn't moved up yet. And then you've got structural investment in AI today, in general, the infrastructure build out, data center and the like. We think that's 50 to 100 basis points of tailwind to growth every year between now and the end of the decade. And that doesn't even begin to factor in the potential productivity enhancements that come. So all of those things are these points of resiliency that have driven the economy through bouts of uncertainty over recent years. And we think that they'll be transcendent again this year.
If this is stagflationary or some level of stagflation, could it not be that bad? I mean, that's basically the implication of what you're saying, that stagflation isn't necessarily problematic for returns if there is this sort of structural investment underpinning it.
Yeah, absolutely. So the word stagflation comes from history when it was a really bad time. The word recession in general, again, people in the industry today have only ever seen deep scarring recessions associated with shocks. We haven't had a garden variety recession in the U.S. since the early 90s. So when I say stagflation this year, I'm talking about at the margin. You're talking about modestly slowing growth and inflation that stays sticky high, but it's still a pretty good nominal GDP outcome.
We're not going to ask you who you want to be the next Fed chair, but there is a question about whether this environment does legitimize the discussion of wait and see at the Federal Reserve, that rates should actually be around where they are because there is sort of an inflationary impulse that comes with the strength you're talking about.
I give the Fed a ton of credit for where they are. I think they're front-footed today. given the setup. And so when you think about the last time the Fed hiked, July 28th, 2023, to 5 3/8, core PCE inflation then was 4 3/8. So you had a 100% real rate. Today, backward-looking core inflation is 2.5. The policy rate's at 4 3/8. So your real rate is higher today. So with the setup that tariffs might or might not be inflationary, inflation's still above target, the Fed can now focus on the labor market. And so we haven't seen demonstrable weakness as measured by the unemployment rate yet. But if you get any modicum of weakness in the labor market, I think the Fed will react very quickly.
Are you concerned about a shadow Fed chair?
You know, listen, I understand the intrigue, the palace intrigue about all of that. I believe in the sanctity of the institution. I think there's a lot of very, very smart people, and they will be looking at the data and make the right prognostication and the right policy prescription for whatever the outcomes are. So I think that's very interesting. I love the history of the Fed. I don't think the independence of the Fed is in jeopardy.
If you had to game it out, if we were to question that independence, would that lead to steeper yield curves, a weaker dollar? Is that what you'd expect?
So, listen, I think that an important guardrail around policy in general is the financial markets, and I think you saw that that's probably the closest to the money guardrail. You saw that happen and play out in April in a pretty big way. And so I think the markets would protest any kind of degradation of that independence very quickly.
Do you lean against the weakness in the dollar that we've been seeing and certainly are seeing this morning?
I think it's a great discussion. I think on the one hand, you've got the status of the world's reserve currency, the dollar. That's not going anywhere. That's like trying to change 200 countries off the metric system. It's too embedded today. It's not going to happen. U.S. exceptionalism is about returns, superior returns in U.S. equity markets, higher yields and more ubiquity of credit opportunities in U.S. fixed income assets. The dollar is a different discussion. If the dollar is going to be engineered lower as a political matter and you're a foreign investor, you might have a decision on the one hand, I'm going to keep my U.S. assets, but a different decision as to whether you want to hedge the foreign exchange exposure. So if it costs you 200 basis points a year, if you're a European investor, to hedge your U.S. equities, you might do that. But that's different than selling your U.S. equities.
Is it still the golden age of income?
It is absolutely the golden age of income. So glad you brought that up. Throughout all the uncertainty, what works is carrying. We love 3-day weekends because you earn your carry and there's no volatility in the market.
We all do, by the way. Weekends anymore.
But when you can put together, through all this uncertainty, an investment grade rated portfolio that yields 6.5% to 7% in a 2.5% inflation environment, getting these real yields, and because you own your duration in that front of the belly of the curve, you don't have all the implied volatility. That's the highest Sharpe ratio portfolio we've been able to put together in my entire career.
Are you a metric guy or an imperial guy?
I like both.
Yeah, I'm like this. I'm the same. I do distance in miles, speed in miles, and then temperature in Celsius.
Oh,
it's
no.
like a polymath.
You can't do that in your head, Celsius to Fahrenheit.
No, I can't do that. I could sort of roughly sort of game it out, you know?
I'm
but I know that sort of mid-30s is triple digits, and that's how things
35
work.
is hot.
That's super hot. There we go. Russell, good to see you. You a mix as well? Do
No,
a bit of both?
absolutely not.
Just what are you? Imperial?
I'm sorry. It's just that's my upbringing. But I'm learning. I'm learning from you. You start talking and,
Mix of Europe, the UK, and, you know, sort of blend it together.
Yeah, I know. I'm
all
not.
right.
It's 28 degrees Celsius today.
Thanks for that.
You're welcome.
What's that in Fahrenheit?
82.
There we go.
I was going to quiz you.
Helping out the people of New York. Future mayor. Do you want to run? No? Independent? Don't
Never
fancy it?
know.
Russell Brownback of BlackRock. Russell, good to see you. Thank you, sir. Coming up on this programme, Scott Chronert of Citi, Adrienne Yih of Barclays, Nela Richardson of ADP, and the San Francisco Fed President, Mary Daly.
As long as earnings are okay, the market can ignore a lot of the bad news.
The whole market looks pretty good, actually.
The market has been remarkably resilient.
Markets seem to be calling the all clear here.
We're going to see in the short run as the market can move higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, 30 minutes away from some economic data in America. Before we get to that, we need to get to this. Tracking the latest developments down in Washington, D.C. Any moment now, a briefing in the Pentagon press briefing room with the U.S. Secretary of Defense, Pete Hegseth, and the chairman of the Joint Chiefs of Staff, Air Force General Dan Kane, on the latest from the events over the weekend, just how much damage was done in Iran.
Well, I think when it comes to how much damage was done, you've seen this administration really push back on the leaked report from DIA that was in the CNN and New York Times. I think constructively you need to look at the situation that even today, they probably don't have a precise damage assessment. Why? It takes a lot of time to get that data collection. Do you think the Iranians have a full, precise damage collection? We don't even know where the supreme leader is at the moment. Do you think they actually know on precise damage that was done to their nuclear facilities? Yesterday, they said their installations were, quote, badly damaged. But to get exactly how far they are taken back in terms of their capabilities, the IAEA said they don't know yet. It's months or it's years.
That news conference just moments away. When it begins, we'll head over to it and bring you some of the headlines. Also moments away, I mentioned some data at 8:30 Eastern time. The highlight, there's a lot of it, but the highlight, it's got to be a read on the labour market.
Given the fact that jobless claims have been creeping higher when you take a look at the 4-month and 6-month moving average, a real question of whether we're seeing cracks in the labour market. We've had a number of guests this morning who have said absolutely we are seeing signs of weakening, but not necessarily weakness. That is going to filter into the parlor game that we keep talking about, which is who is going to be the person or the people who are going to be discussing this at the Federal Reserve.
We might be playing this game for a long time, right?
I think everyone's a little sick of it already, but we're going to be playing it and it's going to be great.
2 hours in and you're sick to death of the journal story.
I'm not sick to death of it. I just think that there's a lot at play underneath the market right now.
This is vintage Trump. He loves producing a moment. And right now what he is producing is who's going to be the next Fed chair. And, you know, to a lot of our guests' point, this is probably better than him coming out and saying, I want to fire Fed Chair Jay Powell. It's more like, I might announce someone, I have a few names, palace intrigue.
A lot of palace intrigue right now. That news conference just moments away. Coming up this hour, we'll catch up with Scott Chronert of Citi with stocks near all-time highs. Adrienne Yih of Barclays looking ahead to earnings from Nike and the San Francisco Fed President Mary Daly as markets look for change at the Federal Reserve. We begin this hour with equities stalling near all-time highs. Scott Chronert of Citi is positive, writing, we believe higher margins support higher multiples. Ongoing technological advancements, think AI for one, will add yet another element to the productivity storyline. Scott joins us now for more. Scott, good morning, sir. Within 1% of all-time high. It's as if April 2nd never happened, Scott. Did April 2nd happen?
You know, Jonathan, the way I think about it is that it's, you know, what doesn't kill you makes you stronger. And April 2nd happened. It brought us to the edge of the cliff, if you will. We looked over the edge at what that magnitude of tariffs might have done, and it would have been very disruptive to a broad array of company-specific business models. So what's happened here, it happened, it caused the correction, it caused some right sizing in terms of valuations and a new refreshing look at the fundamental setup. And as we've stepped back from that, I honestly think along with the deep seek phase back in the early part of the year around AI, the combination of the two have actually set up very well for this rally towards new highs.
It's got a lot of questions about the Federal Reserve story out of the Wall Street Journal overnight. Lisa's already sick of it.
Okay.
You're not sick of it?
Well, it's just that it feels like it's kind of missing the point of what actually is the debate, which is the economy weakening?
Agreed.
Is inflation going down?
There we go. So let's continue with that, Scott. She's not quite sick of it, just wants to focus on other things. How Fed dependent are these all-time highs, Scott? Are we even thinking about rate cuts being needed to drive this equity market higher?
You know, Lisa, I'm not going to say I'm sick of it. Jonathan, I agree with where you're going with this. The way I look at it is that the U.S. equity markets are very good at dealing with incremental change. They're not so good at dealing with shock effects, okay? Liberation Day was a shock effect. Deep Seek was sort of a shock effect. What's happening with the labor market is a gradual unfolding more negative narrative in terms of the consumption trends. We highlighted this with Q1 earnings. We think it's a natural extension of where we've gone in the post-COVID world, and it's kind of setting up for what we think is going to be sort of a more mixed consumer dynamic at work that's going to end up influencing where consumption patterns go, probably where broader labor patterns go, but with a very mixed or almost muted impact on U.S. equities.
Scott, something Lisa's been great about is just drawing a distinction between the market and the economy. The market's not the economy. With all of that in mind, how do you think about leadership in the stock market?
Well, once again, I'm going to agree with Lisa on this. We for years we've been saying, hey, don't confuse Wall Street, i.e. the S&P 500, with Main Street, i.e. the broader U.S. economy. Wall Street's beating to a different drum right now in terms of earnings resiliency. As you pointed to at the top of the show, our focus on margin improvement, productivity enhancements over time, all of these provide a fundamental tailwind for different parts of the market at different times. Right now, what you're seeing is this, sort of maniacal focus on growth triggered by the AI investment spend, which is not going away. We're probably more comfortable in that now than we were, say, a year ago. And what it's doing is perpetuating this growth influence that's reading through, obviously in big tech, but it's reading through to the broader index levels. And we think all of that is still in very good place. We've been overweight tech, comm services going into Q2. Don't see any reason to really change that at this point. That's where the leadership is. If anything here, what we're looking at is probably a little bit more risk of a melt up akin to the 97, 98, 99 timeframe in U.S. equities before we got to, eventual bubble burst.
What an interesting final point. Scott, really smart, as always. Scott Chronert there of Citi on this equity market. Scott speaking to what we've heard a few times now. The pain trade is higher. He's looking potentially for a melt up that we saw way back in the 90s.
And this is what a lot of people have said, that still people are positioned for weakness that we might be seeing on the margins in economic data. But the reality is the market's moved on, and they've moved on to AI that will replace us all and make labor.
Is that what's going to happen?
I mean, I think
this is so gloomy.
Okay, let's go to something heavier.
We're going to move on to something much heavier. We're tracking the latest developments out of Washington, D.C. Promise you an update on this briefing, which is underway with the Defense Secretary, Pete Hegseth. Let's take a listen.
What this assessment, a linchpin assumption, you know what that is? That means your entire premise is predicated on a linchpin. If you're wrong, everything else is wrong. And yet, still, this report acknowledges it's likely severe damage. Again, this is preliminary, but leaked because someone had an agenda to try to muddy the waters and make it look like this historic strike wasn't successful. I'm going to get to the chairman in a moment because he's going to lay out the particulars for you based on his professional military experience. But here's what other folks are saying. The DIA that put that report out says that this is a preliminary low confidence. It points out that it's not been coordinated with the intelligence community. How about the Israeli Atomic Energy Commission? There's the devastating U.S. strikes on Fordo destroyed the site's critical infrastructure and rendered the enrichment facility inoperable. Have any of these quotes made their way into the New York Times or the Washington Post, MSNBC, CNN? Any of these quotes? How about this one? This is a new one from the UN, the United Nations. No friend of the United States, or certainly Israel often. Here's the head of the UN Atomic Energy Agency this morning, Rafael Grossi. U.S. and Israeli strikes caused enormous damage to Iran's nuclear sites. Don't take my word for it. How about the IDF's chief of staff? I can say here that the assessment is that we significantly damaged the nuclear program, setting it back by years. I repeat, years. The Iranian foreign minister, the spokesman, our nuclear installations have been badly damaged, that's for sure. I'm sure that's an understatement. John Radcliffe, the director of the CIA, putting out a statement just last night. CIA can confirm that a body of credible intelligence indicates Iran's nuclear program has been severely damaged by recent targeted strikes. This includes new intelligence from a historically reliable, very different than preliminary assessment with low confidence. He's saying historically reliable and accurate source and method that several key Iranian nuclear facilities were destroyed and would have to be rebuilt over the course of years. CIA continues to collect additional reliably sourced information to keep appropriate decision makers fully informed. How about DNI Tulsi Gabbard yesterday? She writes, and I quote, "New intelligence confirms what POTUS has stated numerous times. Iran's nuclear facilities have been destroyed." Institute for Science and International Security President David Albright, overall, Israel and U.S. attacks have effectively destroyed Iran's centrifuge enrichment program. Time and time again, I can go down the list. Those that understand, those that see, those that do proper assessments recognize that what the United States military did was historic. And again, before I pass it to the chairman, because you, and I mean specifically you, the press, specifically you, the press corps, because you cheer against Trump so hard, it's like in your DNA and in your blood to cheer against Trump. because you want him not to be successful.
That was a press briefing with Pete Hegseth, the Defense Secretary. Exactly what we expected. Some heat for the press given the coverage of the strikes over the weekend. Still not clear how much damage was done, but he seems to have a high degree of confidence that a lot of those sites in Iran, the nuclear sites, were totally obliterated.
I think we really need to wait for more of the data collection to happen. This is sensitive material to get the precise understanding of what actually was done to these nuclear facilities and how far back this puts Iran. You had Rafael Grossi talk about the fact that Iran can, of course, rebuild their nuclear facilities. But if they're really damaged, this will take years. At the same time, the president is still looking for a diplomatic off-ramp. He said yesterday, the United States, will be meeting with Iranians next week.
I'm not sure this is a press briefing. It sounds more like a press beatdown at the moment, doesn't it?
It sounds like someone got on the phone with Pete Hegseth and said, please go out there and tell them what we think of their stories. And that is exactly what he's doing.
And he's doing just that. Any headlines, we'll bring them to you. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. The pressure is piling on the Fed chair. The Wall Street Journal reporting that Trump may announce Jay Powell's replacement early. The new chair wouldn't take office until May, but the Journal reports Trump could make an announcement as soon as September. The president said yesterday he has 3 or 4 people in mind for the job. He's called on Powell to lower rates by 2.5 points. Meanwhile, consumer products giant Mars is facing headwinds in its bid to acquire competitor Kellanova. The European Union has opened an in-depth investigation into Mars' $36 billion bid for the maker of Pringles chips, Rice Krispies, and Cheez-Its, my personal favorite. The EU antitrust chief saying the deal would boost Mars' already strong product portfolio. And we end on the NBA draft. The Dallas Mavericks have the next face of their franchise after selecting Cooper Flagg with the top pick. The 6'9" star won multiple National Player of the Year awards during his lone season at Duke. Following the Mavericks, the Spurs selected Rutgers guard Dylan Harper, and the 76ers picked Baylor's VJ Edgecombe. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on. Up next on the programme, the Morning Calls, plus Adrienne Yih of Barclays with a preview of Nike earnings due out later on this afternoon. The opening about 1 hour, 17 minutes away. Stocks are higher, positive by 1/3%. The opening bout is 1 hour and 14 minutes away. Equity futures positive by 1/3%. On the Nasdaq, up by 0.5. On the Russell at the moment, positive by 1/3%. Just want to touch base with the bond market briefly and talk about the very front end of the yield curve. It's starting to get more interesting. It's 5 consecutive days now that we've seen yields lower at the front end of the curve on twos. So we're back down to 3.76 and we're heading lower, down another 2 basis points, opening the door to, I think, a live discussion in July, a live discussion about reducing interest rates. And even if they don't cut, we're expecting the possibility of descent. And then just on the margin, I know you don't want to talk about it, but we should talk about it. On the margin, the prospect of a new Fed chair being announced sometime soon to take over from Powell next year.
You know, and this really goes to Neil Dutta's point. Are we already seeing a shadow Fed? And is that what you really have seen in the price activity? Because since that Fed meeting last Wednesday, we have seen the probability of a September rate cut go from 60% to almost 90%. And it comes to the heels of Chris Waller, who made comments, as well as Mickey Bowman, saying that July could be that live meeting, along with some data that potentially is disinflationary. Just wait for PCE tomorrow. I'm excited.
Are you excited for that?
I am.
What about claims at 8:30?
I actually think it'll be really interesting.
We've got Lisa's attention for the next 40 minutes. Good news.
That's your auction.
Euro dollar right now 117. That dollar weakness still coming through in the FX market. Another session of euro strength. 117, the highest going back to 2021. That's the price action cross asset. Let's get you some morning calls. First up, Morgan Stanley raising its price target on Microsoft to 530, citing upside for the company's Azure cloud service. That stock is up by 0.3%. Your second call from JP Morgan cutting its price target on Apple to 230, expecting macro uncertainty to weigh on iPhone 17 demand. That name is down by 1/3%, or rather 1/10 of 1%. And your third and final call, it comes from RBC, upgrading General Mills to outperform, noting encouraging guidance despite a sluggish backdrop. The stock is up this morning by 1%. Let's turn to another company reporting earnings. Nike results due out after the closing bell. Adrienne Yih of Barclays has an equal weight rating on the stock, writing the following: we see more pressure in the near term, which could be exacerbated by the overhang of tariff pressures and demand uncertainty. Adrienne joins us now for more. Adrienne, welcome to the program. Let's just go from the top. What are you telling clients about what to expect later on?
Yeah, so the company is reporting its fiscal fourth quarter. They have been doing a guidance philosophy of just doing the out quarter. So we expect to get lower guidance on the fiscal first quarter ending in July, but they probably will give us some color on FY26. And we certainly expect that the kind of post-earnings consensus revisions could be revised down to kind of the 170 to 180 range. That's about, call it 7% lower than the street. That's not bad for a company that's been lowering earnings for 4 or 5 consecutive quarters. So while we're equal weight and we think they're going to lower, the sentiment is negative. Stock has been underperforming last year, year to date, and since the last earnings call. So I would say that we're equal weight, and we actually, dare I say this, are looking to be more constructive, believe it or not, in a contrarian sort of way as we go into the next couple of quarters, because certainly Elliott Hill is doing the right things.
Adrienne, let's talk about one particular region before we get to what the CEO is doing. I want to talk about Asia, and more specifically maybe China. When you think about that continent at the moment, are you more worried about that continent as a source of demand or a source of supply?
Both. I mean, it's unfortunately, the demand outlook, particularly for Nike and the footwear industry, they have been incredibly and heavily so. This is very, very company specific. So outside of the overall macro trends that are pressuring the China market, we've seen some deceleration or second derivative kind of slowing in the negative impact on that macro environment. Having said that, for Nike, they were extraordinarily promotional. They were trying to get through inventory last year, so they need to anniversary that. And that's usually not as a good year for margins, and it's never a great year for top line sales. In terms of supply, Nike has about 17% coming from that region, significantly more exposed than other footwear manufacturers. And so we expect to hear from them as well, pressure on this incoming August quarter coming from the tariffs as well.
Do we have a sense, Adrienne, of who's going to end up paying for them, of whether Nike is passing them on in terms of higher prices to consumers, or whether that just means tighter margins going forward?
It's a little bit of both. And what I would say is thematically, what we think Nike is going to talk about are kind of price increases that will obviously start with the July, August back to school timeframe. Our supposition or the expectation that we have for kind of Nike's pricing philosophy is that under $100, probably a do nothing scenario, between $100 and $150, selling price, probably about a $5 price increase. And we're expecting about over $150 shoes, very selectively, but on average, probably about a $10 price increase. All in, that's about a 4 to 5% total, what we call ASP, average selling price increase for them. So the main and biggest way to solve this tariff problem is to pass that on to the consumer. But also through the supply chain, we also expect a shared environment, both with their vendors and with their marketplace partners like a Dick's or a Foot Locker.
You have a really complicated job right now. I mean, trying to decipher what is macroeconomic and what is name specific at a time when we were talking about Nike losing market share to other producers, whether it's On, whether it's Hoka. How much is Nike in a position to keep some of those higher income earners, these higher income consumers that are able to pay some of the higher prices to offset some of the otherwise what would be margin compression from tariffs?
That is the million-dollar question, and you are spot on with identifying that as the difficulty, right, for Nike specifically. If you are On running, we've already seen On raise prices, right, when it launched a new product in Q1, successfully pass through brand equity, mind share. It's all there, and they passed it through without any problems. If you are Nike that is struggling to regain mind share, it's really, really hard to raise prices while trying to do that. So there's this weird sort of juxtaposition of I need to raise those prices in order to offset this margin pressure, and yet I don't have the brand equity and the mind share that the consumers want to pay more. What I will also say is that they are bringing to market a number of new, untested, a whole swath of a dozen new releases to offset what we call the big three, the Air Jordan 1, the Air Force 1, and the Dunk, right? Tried and true, decades-long, winners, and you have new product into the cycle. So for Nike, it's a very company-specific kind of problem for them where they're trying to have this push-pull environment of offsetting the tariffs, but then needing to sort of induce both customers to come back as well as their marketplace partners, right, to give them shelf space.
And any evidence yet that these new brands like Nike Skims is actually working?
So we're all probably going to hear about that. So Nike X Skims, like last week. So there's two big announcements intra-quarter that happened. The first of them was that Nike is now going to go with Amazon, right? That's a great positive in terms of a new channel partner. So new version of wholesale sales. So we actually like that. That's a net positive. At the same time, about a week ago, I think it was a week ago, they also talked about the deferment or the deferral of the Nike X Skim. So that actually is going to get tabled. People have said that that's sort of a negative. And what I would just say is that the company has so many different initiatives that it's driving. And of those two, the bigger one that's going to impact the business is the Amazon relationship. So I think they're reorganizing and re-strategizing on where is the biggest bang for management's time, the capital, and the efforts of the company. And I think you're starting to see a lot of those decisions being made in real time.
Adrienne, good to catch up with you ahead of those numbers later. Adrienne Yih there of Barclays on Nike talked about the strategy of Elliott Hill and the difficulty as well. The mitigation tariffs, mitigation strategies for the tariffs. You've got to get that brand heat back, the innovation, refresh the cycle at the same time. That is tremendously difficult, and address the problems they've had with distribution over the past few years. Where
they tried to go more to just come to our website and buy it rather than distribution of a number of different stores for sneakers. I just wonder how you deal with this, given the fact that they really got out of the running loop. And Hoka and On Holding really took over how you get that pricing ability to really offset margin compression.
That's why they're coming to market with a number of different brands like Nike Skim, seeing if they can get people back into this excitement. At the same time, though, people still love Air Jordans and Dunks. You have to keep the old brands as well. So they have to do a lot at once.
People, but not runners. And that's the issue.
Not runners.
One of the issues. I think it speaks to a much bigger issue at Nike. And that's the problem. It's not that you lose the running sector and you've lost everything as a company. It just speaks to them taking their eye off the ball of a much, much bigger issue over the past few years.
Just, my on-the-ground research with the sample size of one at home is that the resale market for Air Jordans hasn't been as hot lately, and it's not necessarily the same type of...
I have a pair of Air Jordans.
It's your read on things?
That's my read on things.
That's interesting. Do you know what is hot at the moment?
Yeah, these like European brands and some other stuff. I mean, it's all these sort of esoteric
kids are doing
brands.
the trading still.
Yeah.
Nice.
Well, I mean, but there's different kind of trading, and it's sort of...
Where do they source the sneakers from?
Well, a lot of it is secondary market, so a lot of it is sort of used stuff, but in perfect condition, and then they try to keep it perfect.
So they don't wear it?
So they don't wear it, or they walk really stupidly.
So you don't get the crease?
So they don't get the crease. They walk like really dumb.
That seems pointless, but okay. Seems to be making a lot of money, though, from what you've told me. Nike this morning, up by 0.6%. Up next, a double dose of economic data. We'll get jobless claims and durable goods just around the corner. Nela Richardson of ADP here to react, and we'll get the breakdown from Mike McKee. From New York, this is Bloomberg. 60 minutes away from the opening bell. Equity futures at the moment positive by 0.3% on the S&P 500, within striking distance of record highs. In the bond market, on a 2-year bond yield this morning, yields declining for another session, a fifth straight day. We're down by 2 basis points, 375.61. Going into this economic data, we're looking for jobless claims this morning. Claims, the estimate 243, the previous number 245. With the data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Well, we've got a lot of data to talk about. Jobless claims coming in a little slower than some of the others, so let's do durable goods. Durable goods orders on a headline basis hasn't crossed yet, but ex-transportation up 0.5%. The Capital goods orders, non-defense ex-air, what we call core durables, up 1.7% after falling 1.5% last month. So this is good news. Businesses still spending. We will have to see what the breakdown is there. Here's jobless claims. They fall to 236,000 from 246,000 last week. There were a lot of people who thought this may be a seasonal adjustment problem that pushed claims up in recent weeks because school was ending, and maybe that's partly the case here, because we do see a fall of 10,000. Certainly doesn't suggest that the economy is falling back. The advanced goods trade balance comes in much bigger than expected, $96.6 billion. The forecast was for $86 billion. Imports were flat on the month after falling 20% last month. So that's an interesting number. We maybe got some rebounds in orders after the president put a lot of the tariffs on pause. And finally, GDP, this is the third reading. It comes in at negative 0.5%, which is significantly worse than what we had seen in the second reading, which was a 0.2 decline. Personal consumption was only 0.5%. It had been initially reported as 1.2%. So it's going to be interesting to take that apart and see what exactly is going on with the GDP numbers, although they are about 2.5 months old now.
Mike, can I just ask you just to compare and contrast what's happening with initial jobless claims and what's happening with continuing claims, the two stories, the two pictures maybe you could paint looking at those two data points at the moment?
Well, continuing claims have been interesting because they have moved up and down, and the trend should be, we thought, that maybe people were having a harder time getting a job, and that comes out in today's numbers. We go from 1,937,000 to 1,974,000 in continuing claims. Continuing claims would give you the idea that companies are not hiring at this point, which is pretty much the narrative that we've gotten. Jobless claims, though, the initial jobless claims are suggesting that companies aren't firing people either. So everybody's still sitting on their hands, waiting for tariffs, waiting to see what the Fed's going to do, waiting overall for some indication on the economy.
Mike McKee, thank you, sir. With the latest on the economic data conclusion, it's getting harder to get a job.
To me, I think that you nailed it. I mean, it really is continuing claims at the highest level since 2021, since November of that year, because people aren't getting a job so quickly. And it speaks to this question, can we be in this stagnant jobs market for a long period of time without a material weakening, at least in confidence, if not in the actual economy?
Joining us now is Nela Richardson of ADP. Nela, good morning.
Good morning.
You and others have talked about this so-called low churn dynamic in this labour market. Is it getting harder to get a job?
It is, and it is especially for new graduates. We've seen that be a predominant story. So what companies are doing is they're taking a pause on welcoming younger workers into the workforce. They're taking a pause on hiring, maybe even hiring senior roles. They're still in that wait and see mode, a slowdown in the hiring momentum that we saw at the beginning of the year.
Can there be this low churn type of dynamic for a really prolonged period of time without there being some at least perceived weakness in the labor market that becomes reality?
You know what? It's interesting how concentrated hiring has become. If you look at that last government report, what you see is 96% of the hiring has come from healthcare and leisure and hospitality. 2/3 came from healthcare. There's a lot a company can do other than let go of a worker. One thing they can do is cut hours. 55% of workers in the United States are hourly. So we may not be seeing the slowdown in the initial jobless claims numbers, but they are showing up in hours worked. And I think that's a number to watch. Continuing claims is a number to watch. And then the concentration of the employment that's coming, mostly in a very non-cyclical sector, a structural sector like healthcare, that's an indication that everybody else is in wait and see mode.
You know, this is such a difficult market to get a hand around because is it weakening or is it weak? Is this normalizing or is this really problematic? And does it highlight a potential crack to come? What's your take on that? What's the sort of tell?
There's nothing normal about an economy that's not dynamic, especially a U.S. economy. It feeds on dynamism. So I would read the labor market as in a stasis. There's no movement. And that doesn't play out. You asked me how long does this happen until we call it a weak market? Well, it shows up in productivity. If you have a labor market that's not dynamic, that is not, ingesting new talent, is not moving, and workers are going to higher paying jobs and being promoted, that feeds into the productivity numbers, and we saw that the last read on productivity was quite weak, 1.4%. The power of exceptionalism comes from not just workers, but output per worker, and that's what's slowing. That's where you're going to see the weakness first.
Nela, you say it's harder to get a job, but is it easier to get fired right now? Are they the same?
Depends who you ask.
It can be quite easy to get fired depending on what you do.
I mean, take out some of like personal issues. Are companies laying people off?
It doesn't look like that. It looks like people are holding on to their workers. And in fact, we've seen at ADP in the data, in the payroll data, not only are they holding on to existing workers, they're actually rehiring workers that have left and come back. And I think, to your question, hiring has become more cautious. They've changed the composition. Employers are less likely to take a new bet on a worker they don't know. They'd rather hire someone they do know who can onboard quickly, who's very efficient, or not hire at all. That's what we're seeing in the data. And that, again, feeds back into the lack of dynamism that we might be experiencing.
I'm going to ask a question Jonathan always asks. If you're hired right now, you have a job, are you going in and asking for pay rises?
You're probably going in and asking for a pay raise, yes, and not getting it. So, yeah, the ask is there, but the action is not. And you can see that in how our initial job switcher data is looking. Yes, you get a bump from switching jobs, but it's not the same bump that you would have gotten 2 years ago. And it's not the premium of getting that bump versus what your pay growth would have been if you stayed at your previous employer isn't really there. So, yeah, you can ask. Be careful how much you ask for.
Keep asking. Keep asking. I always say that. Keep asking. The companies don't want you to ask, do they?
Well, and
they want to have that leverage, get comfortable, not earning enough.
Yeah, keep asking because the firing rate isn't that high, so, go for it.
Keep pushing. Mike McKee's going to keep pushing. Mike McKee has more data for us. Mike, you wanted to focus on the trade numbers, right?
Well, trade numbers and durable goods, there's a couple of interesting things here. The exports for the United States fell 5.2%. That is the most since the largest drop, shall we say, since 2020. It isn't clear why that would be because prices for U.S. goods have been dropping as the dollar drops. So this is, in the trade business, pretty much a story about exports not living up. Now, on the durable goods side, we saw a rise of 16%, which is the largest since 2014. An increase of 16.4%, but it's almost all Boeing, 158% rise in Boeing non-defense aircraft sales or orders during the month. And some mixed news underneath because factories, the stuff we normally think about like machines and primary metals, fabricated products, those rose, but computers, communications equipment, electrical equipment, and appliances all fell, orders for those during the month. So it isn't clear exactly how strong durables are, even though the headline number is pretty strong.
Mike McKee, appreciate the update. Mike, thank you. Nela's still with us. Nela, wanted to turn to you on the Federal Reserve just briefly. Matt Lazzetti at Deutsche Bank said this is not uncertainty. He says you can see in the forecast a lot of division. Do you hear and see a lot of division?
Yeah, I think that's to be expected. When things are really bad or really good, you should see a lot of consensus. The gray areas are where it's hard to drive that consensus, and it really depends on whether you want, as a policymaker, to make a preemptive move because you may think that the economy is weakening and rates are too restrictive, or you're still in wait-and-see mode. And you can see that various actors are responding to different parts of the economy. It's like we all are looking at a puzzle with missing pieces. And you're trying to figure out what's in the center of that puzzle, and you don't have the pieces at the ready. And those pieces probably won't materialize for months, and in some cases years if you're talking about long-term capital investments. So you're guessing. You're guessing what the center of the economy is. You're guessing about policy over the next 6 months, over the next even 6 years, because many companies that are manufacturers are making 10-year investments, not 3-month investments.
Do they have sufficient information to sit there and say, we're forced to make a guess right now and we've got to make a call? Is that as soon as July, or can they keep on waiting? Because the chairman keeps saying, we can wait, the economy's solid. Is the economy solid?
If you're looking at the unemployment rate, you can go with a solid message. It has not budged in a couple of months, and it's still quite low if you look at it historically. So there is a reason to wait. If you're looking at an economy where, if you look at all the typical median projections, they are expecting slower growth, higher inflation, higher unemployment. If that is your forecast, you might want to make a preemptive move, and that's what some of the committee is doing. But overall, the consensus looks like to wait and see. And they have the data support to do so.
Nela, it's good to see you, as always. Thank you. Nela Richardson there of ADP. Equities at the moment positive by a little more than 0.25% on the S&P 500 with an update on stories elsewhere. Back with us with your Bloomberg Brief. Here's Yahara.
Hi, John. Recapping the flurry of data we just got, U.S. made good exports fell 5.2%. That's the largest drop since 2020. Meanwhile, jobless claims fell to 236,000 from 243,000 last week, and continuing claims came in at the highest level since November of 2021. Meanwhile, Vice President J.D. Vance is set to headline a political fundraiser in Nantucket next month to rally support for the GOP ahead of the midterms. Sources telling us here at Bloomberg, tickets run as high as $250,000 per couple to be part of the host committee and $100,000 per couple to attend. And the feud between President Trump and billionaire Elon Musk is producing a potential winner in Jeff Bezos. The Wall Street Journal reporting the Blue Origin founder has spoken to President Trump at least twice this month as he tries to bag more government contracts. Notice we did not cover the drama around his wedding in Italy. That's your Bloomberg Brief, John.
Yahara, what was the price of that wedding? Do we know?
No, not yet.
What did it come up to? 50 million? I saw a number like 50 million.
I mean, the number of outfits, the number of people, the number of flying, but we're not covering it. I'm not watching.
I think big weddings, I just think it's too much.
Well, three-day event could cost between about $64 million to $76 million.
Wow.
This is according to some individuals talking to
Do you really want to be at your own wedding and not know who the people are that are attending the wedding?
I think they know who the people are. I think that it's who's who of the world. You think that they don't know?
There's a number that gets like those weddings get too big.
I mean, it's difficulty when you've got family members coming in who all like hate each other and they're coming in. You don't know any of them.
Family members, Leonardo DiCaprio,
this is experience
Mick Jagger, Oprah Winfrey, Orlando Bloom.
Bramo speaking from experience, all right.
Let's move on.
Up next, the San Francisco Fed President Mary Daly joins us live from New York City. This is Bloomberg. The opening bounce 44 minutes away. Your scores look like this. Positive by 1/3%, getting closer and closer to all-time highs on the S&P 500. On the Nasdaq this week, already there at another record, up another 0.4% this morning. Just briefly in the bond market, yields lower at the front end of the curve earlier on this morning. That's where we stay. We're down another 3 basis points, 374.59, as traders begin to boost bets on interest rate cuts, particularly following reports that President Donald Trump may fast-track announcing his pick to succeed Fed Chair Jay Powell. The Federal Reserve has a lot to think about already. And joining us now to share some of those thinking is San Francisco Fed President Mary Daly. President Daly, welcome back to the program. It's good to catch up with you. I want to start with this data, and maybe we can spend some time on the Palace intrigue later on. Jobless claims, initial claims lower than expected, continuing claims higher than expected and creeping higher over the past few months. From your vantage point, President Daly, how much weight would you put on one versus the other, and what's the labour market picture look like in your point of view, your opinion?
Well, the labor market's shaping up to be solid, and the data today confirmed that. Now, continuing claims are going up because it takes a little longer to find a job. That's consistent with the hiring numbers just being slower as the economy comes to a more sustainable pace. But when I look at the labor market, there are really no warning signs that it's weakening. We'll continue to watch that, but right now it's progressing solidly, although more slowly than before.
President Daly, a lot of people have said that it is a data-dependent Federal Reserve, and yet we haven't seen enough data to really understand whether inflation is the primary objective or whether it really is some of the weakening that we've seen in the labor market, albeit from a strong place. When will you have enough data to really make that determination?
Well, one of the challenges of central banking that you just have to accept is that we never have perfect data, so you're always making judgments. And you want sufficient data to make a judgment that is really going to be best for the American people. So right now, we have incoming information on the labor market, which does not signal real weakness. It just signals slowing. So we'll continue to watch that. And then on inflation, the data have been good so far coming in. If we were only backward looking, we would say, oh, it's time to adjust the interest rate. But we have to be forward looking. And then you have to make judgments about how you think inflation will shape up going forward. And there I really see three scenarios, and I'm leaning towards one that I'll tell you more and more. But the one scenario, of course, is that it's just delayed. The tariffs are going to have some impact on inflation. It is, after all, an increase in costs, and that will be a more persistent effect. The second opportunity or possibility is that it's delayed, but it will be a one-off. And then the third, of course, which I think is increasingly possible, it's not my modal, but it's increasingly possible, is that this just doesn't amount to as much as the models in history would tell us, because businesses find ways to absorb the costs and they split it down the production chain, and ultimately consumers pay less of that. So I think those last two scenarios, it's delayed, but it's a one-off, or it doesn't materialize to the extent that the models would suggest. Those are where, I'm putting increasing probabilities, and we'll just have to collect some more information to make a decision. But, ultimately, we can't wait for perfect information or we'll be behind, and we can't do that to the American people.
It sounds like, President Daly, you're leaning toward a sooner rate cut if it is confirmed that this tariff impulse isn't as inflationary as people expected. Is that correct?
Well, sooner than what? I mean, my modal outlook has been for some time that we would, begin to be able to adjust the rates in the fall, and I haven't really changed that view. It does seem like that. Of course, if the tariffs are a one-off, you can look through them, and if they're just not going to materialize, then you have to watch both sides of the mandate. And I think that's really important. It's not one or the other. It's both sides of our mandate that have really come into frame since we brought inflation down from the really high levels to something that's closer to our target. Ultimately, we have to watch both sides, and that's what I'm doing. And then the fall looks promising for a rate cut. I don't know for sure. I mean, we have to be open about what we don't know. Humble is, I think, the word that comes out of the inflation run-up. And so, but we will, there's a lot of differences of views on the committee. I see that as a real positive right now, because people bring their perspectives, and the data will guide us to what is the one that ultimately looks like reality.
President Daly, John was talking about the palace intrigue, and I do wonder about how the increasingly political overlay to the Fed has complicated your messaging, given that there is this debate about the dual mandate, et cetera. How much has it affected the way that you communicate?
Not really. One of the things that I recognize on a regular basis is if I go out and talk to the people who live in the 12th Federal Reserve District, so that's 9 states, very diverse states in the West, they don't actually bring this up at all. What they bring up is, what do you think is going to happen to inflation? Will you be able to restore inflation to 2%? Will you be able to restore price stability? Do you think the labor market is going to be preserved during it? Because ultimately, I really want both jobs and lower inflation. I want to be able to get ahead. And so far, the people in my district are cautiously optimistic overall, thinking that the economy is weathering some of the worst concerns and the uncertainties, but continuing to move along. So cautiously optimistic is where they are, and I think that reflects what's on top of their mind, less about what's happening in Washington and more about what's happening in their lived experience in their communities.
So, President Daly, would you dismiss some of the discussions around shadow Fed and all of that as simply palace intrigue and not necessarily affecting what would happen on the Fed? Are you concerned about that?
Ultimately, what I'm concerned about is the 2 mandates Congress gave us, full employment, price stability. There's work to do there. That's where all of my focus is. And the Federal Reserve is an institution. It weathers a variety of different points in time, ultimately because we only think of one thing: how our work can further the American people in their lives and livelihoods, and how we do that through our congressionally mandated goals. So that's what we think about. We've had a durable history since 1913, and I would consider that to be continuing to do our job well.
President Daly, one argument we've heard to reduce interest rates sooner than maybe, say, the fall, as you indicated, is that basically the labour market right now is no longer a source for inflation. And with that in mind, there is space to reduce interest rates because the Fed believes that the policy rate is still restrictive. Does that not convince you enough right now?
Not completely, because remember, inflation's been above our target for some time, well below above our target during periods of time. And there's a sense where people really want us to get that down. Inflation is a tax on people. And every time we let people continue paying that tax, it erodes their well-being. So I'm very focused on getting inflation down to 2%. Us being sure that we're on that sustainable path, as long as the labor market doesn't show signs of weakening, is really important. So you have to make a view. You have to have a view about what you think tariffs will do to inflation. Now, my own view is that they will potentially raise inflation. That's my modal outlook, but they should dissipate over the period. It's not going to be something that builds into inflation expectations, and thus we really have to lean against it. But we can't just be assuming we know just because that's our modal outlook. We have to really collect the information and understand. Remember, data dependence isn't a backward-looking activity. It's a forward-looking activity. Right now, we're looking forward by talking to our contacts, and they still feel uncertain about what they will do. They're going to try to pass some along, but they, as a number of people you've had on your show have mentioned, firms don't have all those abilities, whether they're managing their brand or just they have exhausted consumers who can't take anymore. That's what we're waiting to find out. But I don't think we're behind in our waiting. We policy in a good place, the economy's in a good place, and that's what we'll continue to monitor.
President Daly, how much of a lesson was it last year when the Fed cut by 100 basis points only to see long-term yields rise significantly in the face of growth and inflation expectations? Is that something that you worry about could happen now?
You know, really, financial markets are an input to my decisions, not an output that I'm worrying about. And ultimately, you know, we want to see financial conditions align with what we're trying to do for the economy, and we'll adjust as needed. But, you know, we make policy. There's many things that affect yields. We make policy that we believe will be, with the lags in monetary policy, supportive of both of our goals. And so I don't spend a lot of time wondering what the bond market will do, especially given there's so many things going on in the bond market right now. It's been quite volatile. So really it's about what do financial conditions overall do, and what does that do to growth and activity and inflation? Does it restrain it or support it? And that's where my focus is.
Final
or is it
question.
An input?
Just quickly,
ahead,
President Daly, just want to squeeze this in. What would life be like with a permanent role in Washington, D.C. compared to, say, San Francisco? How would that feel?
Hotter. But seriously, you know, one of the things that my experience with the Federal Reserve is you have to contribute from wherever you sit. And that's what we all do when we get around that table. There's 19 of us, and we don't think about who is in what role. It's really how do we debate, discuss, bring our best thinking and our best disagreement to bear so we can make the right decision at the right moment for the people we serve.
President Daly, appreciate your time. Very diplomatic, as always. There's a better climate on the West Coast, right? California.
Oh, it's just awesome. No humidity.
I know.
It's 53 degrees today. It's 84 in D.C.
What is that in...
Swampy down in Washington.
But it could have been, it's hotter.
Here the money's better on the West Coast too.
Figuratively and literally.
It's important as well. From New York City this morning, good morning. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.